Well, good morning, everybody. Let me welcome you to this meeting of the FDIC's Systemic Resolution Advisory Committee. I confess there's probably no meeting all year that I look forward to quite as much as this one. The engagement on this set of issues with you all is one that I think has been particularly valuable to the FDIC. And if I may say, a particular source of interest and satisfaction to me personally. So thank you. Thank you all for your willingness to serve and for your contributions. I think we have a terrific agenda laid out for you today. At last year's meeting of this committee, not surprisingly, we focused on the regional bank failures that occurred in spring of last year. You all remember that? It's remarkable how many people don't. But we have not forgotten. And while we're going to spend probably the bulk of our time this morning focused on a GSIB resolution in light of last year's discussion, we did want to come back to close the loop with you all in terms of some of the lessons we've tried to apply from that experience last year. And I would note that in addition to the failure of the three U.S. regional banks, we of course had the Credit Suisse episode last year, and we thought we'd have no better authority at the moment to comment on that, as well as the outlook going forward, as my friend and colleague Stefan Walter, who earlier this year was appointed by the board of FINMA, the Swiss regulatory agency, to serve as the chief executive officer for the regulatory authority of Switzerland. And of course, Credit Suisse was the first GSIB to fail, period, in a way, but certainly the first one to fail since the 2008 crisis. And for better or worse, I think we have a lot of lessons to learn. So very much look forward to Stefan's comments. I'll introduce him when we get to his place on the agenda. Following that discussion, we're going to turn to a paper that the FDIC released last year on how the FDIC would undertake the resolution of a U.S. global systemically important bank. This was our effort. I have to confess, John Cunliffe is here. The UK had its blue book. Purple book, sorry. I get the colors confused. The UK had its purple book, so the FDIC now has its blue book. And that book is really designed to lay out in more depth and detail, including operationally, how in the United States we would undertake the resolution of a GSIB. So we will have a pretty detailed presentation on that paper this morning, and very much would welcome your feedback on that. And then finally, this afternoon after lunch, we'll turn to the area of systemic resolution that I frankly think from a U.S. perspective, we've perhaps made the least progress on since the 2008 crisis, and that's the resolution of central clearing counterparties. CCPs were systemic before the 2008 crisis, and as a result of one of the reforms in the aftermath of the crisis, mandating central clearing of standardized derivatives, we took systemically important institutions and, if anything, made them even more systemically consequential, which presents challenges of supervision and certainly challenges of resolution. And I think we are particularly challenged in the United States, I think we made a bit of progress last year internationally in terms of the Financial Stability Board adopting a new strengthened international standard on dedicated resources in resolution for CCPs, which I think was a constructive step. But there's really a lot to talk about there, both in the U.S. context as well as internationally. So we've got a full agenda today, I think, of interesting issues, and very much look forward to your feedback. I guess I should acknowledge that a former member of this committee, Simon Johnson, was recently honored. So I'll declare him a distinguished alumnus. And he was a valued member. As I said in a note to Simon, he always kept us honest, which we were particularly appreciative of. We've got our own Nobel Prize winner to my left. So we always want at least, one on our committee at any given time. But in any event, let me note that I'm joined by two of our board members, Director McKiernan and Controller Sue. If either of them have any comments they would like to offer. If not, let me turn the program over to Celia Van Gorder from our legal division. Celia?
Thank you, Chairman Grinberg. Thanks. Good morning, everyone. Before we get started, because this is an official meeting, we have to make two extremely important official announcements concerning the FDIC's obligations under the Government and Sunshine Act and the Administrative Procedures Act. Some members of the FDIC Board of Directors are in attendance today. The Government and Sunshine Act imposes notice and access requirements whenever a quorum of the board meets to conduct or determine agency business. Today's meeting is not held for such purposes and does not constitute a meeting under the Act. The board members present will only engage in general or preliminary discussions that do not relate to specific proposals for action pending before the FDIC. Any specific issues for official board resolution remain open for full consideration by the board following the conclusion of the meeting. Turning to the second announcement, for purposes of the Administrative Procedures Act, the FDIC currently has pending a number of notices of proposed rulemaking regarding various topics that may arise during today's advisory committee meeting. The FDIC is in the process of reviewing comments received in connection with the notices and will consider all comments to the extent practicable before the board finalizes any of the proposals. Staff will give presentations today on some of the proposals based on publicly available information. Staff is not able to indicate the direction the FDIC or any of the other agencies involved in the notices of proposed rulemaking are likely to take with respect to finalizing any of the proposals. In accordance with FDIC practice, if substantive comments are made on any request for information or notice of proposed rulemaking, the FDIC will publish in the public comment file a summary of this meeting. The summary will generally include a list of participants and a high-level summary of the discussion. If there are any questions on either of these announcements, we do have staff present who would be happy to answer. And now I'm going to turn things over to Director Pat Mitchell to start off the substantive program.
Good morning, everyone, and thank you for joining us today. For our first session of the day, we plan to discuss some of the domestic policy initiatives the FDIC has been working on since our last SRAC meeting. I'm joined at the table today by our panelists for the first session, Senior Resolution Readiness Advisor, Betsy Falloon, Acting Director, Sean Connie, Associate Director, Rob Connors, Deputy Director, Andrew Felton, and Assistant General Counsel, Celia Van Gorder. I also wanted to thank our guest speaker, Stefan Walter, for being here today. We will be hearing from him later in the session. I look forward to his remarks. I will now turn it over to Betsy to kick us off today with the first domestic policy initiative we would like to discuss.
Good morning, everyone. I'm happy to be in the leadoff position with some progress to report on our resolution policy initiatives. At last year's SRAC meeting, we provided you with an overview of a proposal that the FDIC had published in September of 2023 to revise our 2012 rule on IDI resolution planning. We are pleased with the encouragement we received from you to continue the work, and we're happy to provide an update today. The importance of firm-specific resolution planning for large banks was underscored last year. The larger the bank, those experiences also confirmed that while banks between $50 and $100 billion in total assets may be somewhat less complex, they are big, complex, and idiosyncratic in ways that require advanced firm-specific planning supported by resolution-focused information. Following consideration of all comments, the new resolution plan final rule was approved by our board last June and published on July 9th. The final rule, so are we having slides? Wasn't paying attention. Well, I'll continue. The final rule applies to banks with at least $50 billion in total assets, with tiered requirements. For those of you that with slides in your books, I think I'm on slide 3.
Five.
The final rule applies to banks with at least $50 billion in total assets, with tiered requirements for banks under $100 billion in total assets. These largest banks, those with at least $100 billion in total assets, will submit a comprehensive resolution plan, which must include a full resolution strategy. Recognizing that banks under $100 billion in assets also present real resolution challenges, the rule requires a more limited but very useful informational filing from banks with at least $50 billion in total assets. The final rule also made adjustments to the timing of plan submissions as compared to the proposal. The final rule provides for a 3-year cycle for most banks. This allows time for a comprehensive plan review and timely feedback to the filers. This cadence allows for expanded time for engagement and capabilities testing, which are important to our firm-specific planning. Interim supplements filed in the off years will update key metrics and highlight material changes. Working with the firms as plans are prepared and during engagement, together with useful and timely feedback, will assure that progress in planning continues throughout the process. As subsidiaries of the largest and most systemic and interconnected U.S. banking organizations, IDI affiliates of U.S. GSIBs will file every 2 years, which coordinates with the biennial Title I filing requirements. We believe that a cadence in which Title I plans and the IDI plans are submitted in alternating years for these institutions may facilitate useful ongoing resolution planning activities in a manner that works well for the firms and for the FDIC. My slides aren't numbered like your slides, I think, but moving on to the next slide. Focusing now on the expectations for the resolution plans required for the largest banks with at least $100 billion in total assets. The plan must include an end-to-end strategy that is based on a reasonable scenario and is appropriate to the characteristics of the particular bank. While the firms are free to choose a strategy that is suitable for their institution, the rule provides certain expectations with regard to the strategy. While not the only permitted option, the default identified strategy identified in the rule would include the formation and stabilization of a bridge bank. This is because the use of a bridge, where an available option, gives the greatest optionality and is therefore very helpful to the FDIC. The bank would identify the preferred strategy for exiting the bridge. Overall, the information and capabilities required in all resolution submissions are important to give the FDIC the ability to plan for a range of scenarios and different resolution options, including a prompt sale of the franchise. For the largest banks, that includes valuation capabilities that will be helpful for us in developing useful analysis of various options to determine which may be least costly to the Deposit Insurance Fund in an actual resolution scenario. An important element of the rule is enhanced expectations for horizontal capabilities testing, as well as firm-specific engagement. The capabilities testing allows us not only to read a description of capabilities, but to see how effective they may be in practice. One example of this might be a capabilities test to evaluate the ability to timely stand up a due diligence room or a virtual data room with information sufficient to make an informed bid. However, I should point out that we're still evaluating our approach to capabilities testing for the 2025 plans that we're looking forward to receiving and have identified a range of worthwhile options to consider. Now I'd like to hand it over to my colleague Sean Connie, who leads resolution efforts for all the banks under $100 billion in total assets.
Thanks, Betsy. I think we're maybe slide 7 now. I'm not sure. Okay. So Betsy just covered basically the requirements for 100 billion and over. For the 50 to 100 billion, which is the Group B filing, it's, as we stated, is information filing only. And that essentially means that the key components that are not there is really anything strategy related or valuation related is not required. Beyond that, a lot of the components are still very critical in order for us to have the information necessary to have an orderly resolution and a more effective resolution for that matter, including ability to operationalize the failure activities. And some of the components that are included in this portion of the required rule is really what we need to address the people, systems, and process necessary to execute the mission. People meaning like the key personnel, that includes potential retention package or retention strategies. Who do you need to retain? What are the systems? How do they fund themselves? And all of these sort of factors that play into the early going of the resolution. And that can effectively allow us to maximize recoveries. If you think about maximizing recoveries, you don't want to stumble out of the blocks, and this would be a key components of this sort of information that would really help us dramatically, especially in a rapid resolution environment. So for the Group B filings, that's part of the key components that are mentioned on that slide. And then just looking forward on the next slide, as far as what we're doing right now, these filings, as Betsy mentioned, are due in July of 2025 and later. And what we're doing is doing outreach efforts. So for the 100 billion and over, we're meeting with groups of firms and having sessions where we go through Q&A, walking them through the guidance, so that way they're successful in their submissions. For firms that are under 100 billion, we're having one-on-one sessions with them. We're planning to create FAQs as well as these sessions continue. And all of this is to just ensure that they're successful in their submission process. And the last thing I'll also mention is that from the supervisory side, that we're also having sessions with our supervisory colleagues to ensure that we can leverage the supervisory process when it gets into engagement and capabilities testing. So beyond that, we're just looking forward to really leveraging this information once it comes in through the door come next year, and looking forward to seeing any submissions at that point. I'm going to pass it over to Rob now. Thanks.
Ask question.
Sure.
I'd be interested when you say you meet with the banks, with whom are you meeting? People who are executives in the bank, they're lawyers, who is it?
It depends on the sessions. So I can speak to the 100 billion. I'll defer to Betsy for more details on the over 100, but essentially we're meeting from C-suite down to actual participants that would be more engaged in actual operations. So really ground level as well.
I guess the 1,500 billion are legislative limits, right? But they are sort of cliff effects there, right? So big difference between a 49 and a 51. Is it possible to have additional criteria like structure, types of assets, types of business that could be incorporated into designations, or is that just ruled out by the legislation?
As it stands, it's just based on total assets over 50 billion. That's the threshold that was set up originally as well for the 360.10 rule.
I'll just
If I might add, oops, sorry, go ahead.
Sorry.
If I might add one point, that for our own IDI resolution plan rule, there's no statutory threshold. It's a question of regulatory matters.
I had a follow-up question that's quite similar. One of the problems we noticed with the failure of the three large regionals was the rate of growth mattered a lot. And by the time you detected they surpassed your threshold, it was way too late to have the information available. Now, part of this will help, but sort of banking supervision 101 suggests that the people you have to worry most about are those that are growing at an incredibly rapid pace. And we had 3 cases in point. Is there anything in the new rules that would help you catch those cases more quickly?
So one feature of the rule that is helpful, right, is that we have banks 50 to 100 billion in the process, and we, certainly are developing plans for outreach ahead of moving across these thresholds and making sure that our groups are very well coordinated, and we have a process for meeting and discussing resolution issues as well as supervisory issues for banks as they move ahead and cross the threshold. So between, our 2 groups, the the coordination helps us a lot. There's a large amount of content that is required of the 50 to $100 billion banks that exactly the same applies. So we're very coordinated in terms of what we tell the banks and how we do our outreach. The big difference in the plans is the idea of an overall resolution strategy, which is required for the biggest banks, but we would have a lot of useful information should a bank fail without having completed that portion.
That's reassuring, but wouldn't it make sense to have rate of growth be one of the criteria that sort of flags a bank for closer scrutiny, given recent experience?
We think about different ways of drawing these lines, and size is one that everybody can see and everybody can recognize. Obviously, it's not the only one, and we've tried different systems of like trying to tailor the requirements to what the footprint of the firm. For instance, should everybody have cross-border requirements, or should we only have cross-border requirements for banks that have a cross-border footprint? And the way we decided to approach that is to say, everybody has a cross-border requirement. If it doesn't apply to you, explain us that and tell us why not, as opposed to trying for us to tailor too specifically to the firm characteristics. We would like the firms to know everything we'd like to have, and they can tell us why it doesn't apply and isn't necessary in their case.
Maybe I can give you some assurance from the private sector. I think that if we're looking at rapid rate of growth and we're in resolution planning, we're too late. It needs to be more upstream at the supervisory, in the examinations, the MRAs, the MRIAs. And I can tell you that is happening, definitely.
If I can to follow up on Meg's point, rapid growth is one of the big risk lessons we learned last year. Silicon Valley tripled in size in 2 years. Signature Bank doubled in size in 2 years. And the point you're raising, that rate of growth can have significant consequences for resolution. So it really underscores, I think, on our end, the need for a collaboration between the supervisors and the resolution planning folks, because as the size and complexity of the institution may change in short periods of time, we really need to be able to take that into account from a resolution planning standpoint, as we saw last year, because it can happen.
Yeah,
can happen pretty fast.
With cliff effects, it's very quick for one bank to sort of pass the threshold for enhanced observation. And I think the other thing that one could worry about, which you seem to have taken care of by integrating it at the start, is handing off between one group that looks at banks between 50 and 100 and another that looks at 100 and up. And I'm encouraged that you're all sort of coordinating this very closely now, because the handoff is critical.
Yeah, I had a separate question, if it's moving on, which is around valuation. So one of the experiences we had with a couple of near resolutions that didn't quite happen of banks, which in the UK system may look similar to the 50 to 100 billion dollar, is that actually the valuation of the assets is key to knowing how big a problem you've got, particularly if they're not carrying sort of full fat TLAC, if I could put it that way. So was the reason for exempting this category from valuation simply that the cost is too great for them to do that? And how will you manage in a fast burn situation, kind of basically, if they haven't put in place economic valuation, worst case valuation of the assets?
Yeah, I mean, so valuation is kind of a point in time,
Yeah.
component to it. And what would really help us, so keep in mind for the 50 to 100 billion information we are going to ascertain from these firms will allow us to kind of be in a position to do a lot of the work ourselves. So this is to help us inform our own strategy to resolve these institutions under an FDI Act. Now, having said that, some of it just really the types of assets that they have. We can easily bucket them. So for example, even on the securities portfolio, you're going to know quickly, even from the buckets that they have, we can kind of come up with our own valuations for what we expect to receive. So we get a ballpark idea of where they are in terms of where the value is. I think some of the other components that are harder to see in terms of asset valuations are going to be, what is separable from a franchise basis, right? How can you actually separate this business and monetize it in the market? Is it separable at all? I think those are the insights that will also be critical for us to execute.
But you just felt it was too heavy a cost to impose upon them to have those valuation
For
capabilities.
the 50 to 100, just given that we think that we can, we're in a pretty good
Manage it.
position to have an understanding.
Okay, I guess we'll go on to our next topic then. So another of the enhancements that we implemented in 2024 to address risks to financial stability is that in July, we issued jointly with the Federal Reserve guidance to help certain large regional bank holding companies and certain foreign banking organizations improve their Dodd-Frank Title I resolution plans. And I'd like to leave you today with a little bit of insight into why that guidance is important and some of its most fundamental clarifications. So the first reason why this guidance is important is that it will help strengthen plans based upon the lessons that we had reinforced again just last year. We saw that regional banks can and did fail, and if they fail, that can have serious adverse effects on U.S. financial stability. And several of the companies subject to this guidance operate banks, insured banks, that are larger or more complex than those that failed last year and that required the systemic risk exception. We also witnessed that large banks can fail faster or in ways that we did not previously anticipate. And that certain tools that are useful in supervision and that were thought to be helpful in resolution are in fact incomplete for resolution planning purposes, such as stress testing or certain financial metrics. Breakdowns also in providing for either operational or financial needs can complicate the resolution and endanger financial stability. So another reason that we issued this guidance is that we consider what we have observed in prior resolution plans, where there have been inconsistencies in the amount and nature of information provided by this group of companies in certain key areas. And some of the companies simplified their resolution plans by including optimistic assumptions that may not be present in a real resolution event. So this guidance will help support a more comprehensive resolution planning process that is grounded in conditions as may be present in an actual resolution event, and it helps guide the companies in how they may more fully address some of the challenges that may be present. And then lastly, I would add that we had issued guidance to the GSIBs in 2019 and certain FBOs, and this package kind of rounds out a package of clarifying guidance to all of the larger resolution plan filers. Now, in terms of key content or key clarifications offered by this guidance, one of the key components is that the agencies are maintaining the longstanding practice of not prescribing a firm's Title I resolution plan strategy, whether to use a single point of entry At the top of the company, where the subsidiaries all remain open and operating, what we call SPOE, or to use a multiple point of entry approach, where the bank holding company enters bankruptcy and subsidiaries also enter their own resolution regimes, such as an insured bank entering into an FDI Act resolution, which we call an MPOE. That decision should be the firm's choice, and it should reflect its comprehensive assessment of its abilities and risks that its failure might present to financial stability. The simple truth is they know themselves better than we do, and so the strategy is best designed by them. We've made it clear in this guidance that both SPOE and MPOE are acceptable strategy choices. Recognize that these two different strategies have different vulnerabilities and require different types of capabilities in order to be able to execute on the plan. So we've separated the guidance into those aspects that are applicable to firms choosing an SPOE strategy and other content that applies if you're choosing an MPOE strategy. The SPOE guidance, for instance, illustrates that it is not a shelf-ready concept. It requires real planning to be effective, even in a regional banking company. And to that end, the guidance includes sophisticated capital and liquidity prepositioning and execution concepts to help ensure that the subsidiaries remain open and operating during the resolution process. And it also includes governance mechanisms such as triggers to help ensure that the timing for the bankruptcy filing occurs properly so the strategy will be successful. The MPOE guidance recognizes that subsidiaries do not stay open and operating, so companies should approach their planning and their capabilities development differently. For example, a plan involving a failed bank subsidiary within an MPOE strategy does not require resolution capital per se, but it should explain how the requirements of the Federal Deposit Insurance Act could be met without depending upon extraordinary government support, such as a systemic risk exception that was needed in 2023. And if a plan does not provide that kind of explanation, it may be appropriate to conclude that the strategy would not satisfy the FDI Act's requirements, which could represent a weakness in the plan. And while capabilities necessary for the MPOE approach are different and sometimes reduced from those needed for SPOE, certain capabilities remain important nonetheless, such as it's important that they have liquidity capabilities that match up to that strategy, including the ability to analyze the position and project a range of potential needs during resolution, and that they have in place the arrangements that will allow for operational and support services that are material to the execution strategy to continue just the same. And I'll conclude my remarks by before responding to any questions, by summarizing again that this guidance incorporates the lessons of the failures of 2023. It recognizes that either strategy can be acceptable, and it clarifies that the strategy choice requires sufficient planning for both financial and operational needs, regardless of the strategy, but geared to the strategy. I'll stop there and field any questions you may have.
I have a question about what I think of as one of the kind of the key operational issues. So in running the Silicon Valley Bridge Bank, we were successful in getting in place retention arrangements for the vast majority of employees. And I was pleased to see that reflected in the plans here. But one of the things we never were able to get done was a retention plan for the executive team. I think there was understandable wariness about giving retention awards to folks who might have contributed to the failure of the institution. But as you're thinking about running a bridge bank for any length of time, being able to keep those key executives in place is essential. And I'm curious as to how you all are thinking about that, given this tension between the fact that there is wariness about rewarding folks who may have contributed to the failure. On the other hand, one certainly as a CEO who is stepping in to run a bridge bank,
they're important. Whether or not the FDIC, if it's executing a bank resolution, or if it were Title II, it does that, well, that's going to be a circumstance-dependent decision. In the Title I world, it's really more about the company making sure that they've identified who they need, and as they are preparing their bankruptcy process, they are working to retain who they think they need to do. Remember, if things go as planned in a lot of these situations, or at least in an SPOE, it's just going through the bankruptcy process. The subsidiaries stay open and operating, and the FDIC can be an observer and doesn't really need to engage. And so that's how the Title I is largely built up. But if it is a MPOE within Title I, then we have some principles here, and then we incorporate also, as Betsy discussed, that's the IDI 360.10 rule, which goes into more depth around what's needed to actually execute an IDI resolution.
I'll just add to that a little bit. I think we touched on this a little bit last year as well, because it is a takeaway from last year's events that, we have requirements for retention plans built into our resolution planning requirements. But when you get to the senior executive level, there's a tension between accountability and at this point, you're still fact finding versus retaining the people that you need to continue to successfully run the enterprise. And I would say that's an ongoing effort. We recognize that it's really important to be able to keep in place the people that run and manage the institution to have a successful bridge and to in a short-term bridge, it was very hard. In some cases, we may be faced with a longer-term bridge, and it's even harder. So we recognize the problem, and it's something that we have been giving a great deal of thought to, but I don't think that problem itself, speaking for myself, is solved in the resolution plan. We ask for information, we ask for a retention plan, but when you get to those senior levels where, the question is one of accountability versus, giving them the assurances that they need to continue to stay at the table and do the job. I don't expect to find that in the resolution plan, but it's something that we need to be working hard on internally.
Yeah, I was just going to add a small point. Beyond just the bridge, we look at retention or key personnel throughout the resolution life cycle. So even things that are retained in receivership, what are the operational systems around that you need. So we get pretty ground level, depending on the business that are held, and even overseas operations, you'd want to know how they're, who are the key people to retain in those areas to maintain or essentially keep the lights on until you can monetize them or resolve them.
Sure, I don't mean to suggest that the senior most executives are the only key operational personnel. They're not, but just speaking from my own personal experience, trying to sort out those issues in the middle of a crisis is just about impossible. And one's not going to get to any answer around accountability in a matter of a week or 2 or 3. It takes a long time. And so my respectful suggestion would be one just needs to decide whether you're willing to make those awards and keep those people in place, except for those people you've clearly concluded are accountable, and then have some mechanism to take that money back in the event that the accountability process ultimately does show that those people are accountable. But waiting until you're actually in the midst of the crisis to sort out those retention issues at the executive level, I think means ultimately they just don't get resolved, which means that you have a lot of potential instability in the situation.
Can you hear me? I have a question, or maybe it's a statement, but hopefully there'll be a question in there somewhere. Back to the valuation issue that was raised before. So I was, 24 years a supervisor. I understand the challenges of being a supervisor in these situations. I think it's great that you have confidence in your ability to do valuation of simple portfolios, et cetera. But the fundamental point here is that this is the bank's job, right? The bank is supposed to be running itself, and you have an expectation for a process that they're supposed to have. So I would advise you, as an advisory committee member, to focus more, to put some emphasis on whether the key people in the institution are actually capable of doing their job. And if they can't do appropriate valuation under a variety of potential scenarios, I think the answer is close to no. So I just put that out there. Now I'll get to a question maybe. So guidance has been around for a while now in resolution planning, 2016 or 2014 to 16, whatever. It was a long process. I was there for some of it. How is that working? Because my initial concern at that point in time was that we should actually be putting things into rules rather than as guidance. We all know guidance can be squishy. It's quote unquote not enforceable. Since that time, all of the agencies have come out and actually further downplayed the importance of guidance publicly in a statement. I can't remember exactly what year it came out, but 2017, 18. So basically telling their examiners, hey, be careful, don't use guidance too much. But one of the most important things we have asked these firms to do, we're actually putting a lot of it into guidance. How's that working?
Yeah, so my opinion is that it has been very helpful because, so I think at first is that the guidance isn't a checklist of things that you must do, and if you do them, you pass. If you don't do them, you fail. The threshold principle is still whether or not your plan is credible or is not credible. It would facilitate an orderly resolution. That's still the standard. And the guidance is just meant to help provide insights and considerations and tools that the firms might use to help demonstrate that they can, in fact, execute on their plan. And in some of the conversations that we've had with the industry over the years, we've seen some advancements that have not come from the supervisory agencies, but came from the industry as they thought about trying to implement some of the general concepts in the guidance, like RLEN, which is your liquidity execution need and the ability to have the liquidity and to be able to estimate how much you need and have it and then do your bankruptcy process. They've built some systems to do this. They've thought about the fact that conditions can change and that you need to be dynamic, not just calculating a number as of one point in time. So the guidance pointed the direction, and I think that it's been helpful with some of the institutions thinking about this and then trying to operationalize. I won't say we're fully there. We're not. The findings from the last Title I review showed that, but it's a step.
Okay, thank you. Yeah, I mean, I do understand the challenge there. I guess well, I'll leave it there. I can come back to this.
So one of the lessons from last year was just how rapidly cash moves out of these institutions. And I guess it sounds like you focused on that in this guidance, but I also want to make sure that you've focused on what appears to me to be the greatly increased cost of complicated Chapter 11 cases. You look at the cost of FTX, for example. And I don't know if your planning includes that type of budget. You're talking like $100+ million easily for that.
So I'll admit that we haven't tried to enunciate every kind of expense that these companies might have to have, but one of the concepts again is our cap. And RSEN, you have to pre-position capital. You have to have enough capital to complete your resolution if you're doing the reorg and bankruptcy. And any costs, any business operations, any expenses would eat into that capital. So if that cost is increasing, what firms will have to do is recognize that as an expense, and it'll effectively accelerate the trigger point at which they file because they've gotten closer to hitting that threshold point in their capital ratios. So while I wouldn't say we've captured it by name, anything that eats into your capital cushion should be captured into your RCAP and RSEN modeling.
It's not the type of thing you can resolve with TLAC. It's real cash.
Right.
Should we move on? So last year we discussed the notice of proposed rulemaking that the FDIC, Federal Reserve, and OCC had recently published, proposing a long-term debt requirement for regional banks. And well, the FDIC and the other agencies are still in the process of analyzing comments. And as Celia mentioned before, I'm very limited in discussing any aspects of our thinking or where we're going on the final rule. We thought it might be of interest to the committee to briefly review that NPR and hear about the aspects of the NPR that attracted the most significant number of comments. The NPR generally proposed a requirement for IDIs to issue subordinated, unsecured long-term debt from their to their holding companies, which would then issue debt to the markets. This could be used to recapitalize a failed bank and expand the range of options that the FDIC could use to resolve a failed bank. I would say there are three areas of the NPR that attracted the most feedback from the public: the minimum denomination requirement, the dual holding company and IDI requirement, and the calibration of the requirements. In the NPR, we proposed that the bonds would have to be issued with a minimum denomination of $400,000. This would have been a new requirement for TLAC bonds issued by GSIBs as well. And the point of this was to ensure that the debt would be held by larger, more sophisticated investors who would be better placed to absorb any losses associated with these instruments. We've seen other jurisdictions face issues when bail-inable debt is widely held by retail account holders. The denomination amount was based on analysis of retail bond holdings using the Survey of Consumer Finances. However, public comments were generally opposed to this feature. Most bonds currently issued by banks have denominations of either $2,000 or nothing at all, and commenters expressed concern that this would decrease liquidity in the market. They also asserted that direct retail holdings of bank bonds are currently de minimis in the United States, unlike some of those other jurisdictions. Another area of public comment was the dual requirement that covered firms issue externally from their holding companies and then downstream that to their bank subsidiaries. This is a slightly different setup than the existing TLAC rule, where the prepositioning expectations are less strictly defined because of the existing GSIB Title I guidance related to capital and liquidity prepositioning. Under the long-term debt proposal, we required full prepositioning at the IDI because the firms in scope of this rule all have the majority of their assets in the IDI, and we think that is the most likely source of failure of these firms. However, commenters identified some potential frictions in imposing this requirement that we are considering carefully. First of all, the requirement may have an effect on the consolidated firm's liquidity coverage ratio. The LTD issued by the bank IDI will typically improve the IDI's LCR. However, this increases the amount of trapped liquidity at the IDI, which can't be counted in the consolidated firm's LCR and therefore might lower the consolidated LCR. This wouldn't have an economic necessarily on the liquidity at the bank, but it would have the effect of lowering the consolidated ratio. Furthermore, for firms that already have issued LTD at the parent level, but deployed it in some other manner, typically, for example, as an equity investment in the subsidiary, it may be difficult to convert this into long-term debt and therefore might require them to issue long-term debt above and beyond just the minimum requirement, at least for the period while they're rebalancing their balance sheet. And finally, we received a lot of feedback on the calibration of the proposal's requirements. The proposed calibration was 6% of risk-weighted assets, 3.5% of average assets, and for firms that are subject to the supplementary leverage ratio, 2.5% of their total leverage exposure. These numbers were calibrated under a similar capital refill framework as used in TLAC. However, some commenters suggested that regional banks, particularly the Category 4 firms, might have less frequent access to the larger banks and GSIBs, and that a lower calibration might be appropriate. I hope this has been a helpful overview of the comments. We're considering these and all other comments from the public very carefully, and at a future SRAC meeting, I look forward to updating you on the final rule and its implementation.
Question from my side, if I may, on the calibration. This also goes back to our prior conversation about valuation. My back of the envelope is that these requirements, if applied to the regional crisis, would have cut DIF losses by 50, 60, 65%, depending on exactly how they're implemented in practice, which is great. It really privatizes and internalizes some of the risks that banks take. But one of the challenges we faced last year was that banks were in a pretty big hole because of mark-to-markets on securities portfolios, but also some loan portfolios, as in the First Republic case. I know there are some reforms going at available for sale securities, but do we feel those have gone far enough to also look at the hold-to-maturity accounts and the loan accounts to make sure that we've captured some of those interest rate risks more broadly, and we haven't simply moved it from one bucket to another. So we're not starting in such a deep hole when we're looking at the TLAC refill.
Sure. So a couple of points there. So first of all, there's some, obviously, as you know, some pending rulemaking on capital requirements around securities portfolios and AOCI. This has also been an area that the supervisors have spent a lot of time looking at, making sure that banks have adequate liquidity and that they're able to monetize their HQLA portfolios, and looking at held for available for sale versus held for maturity, the percentage in each bucket. And also, you know, we're one of the aspects of the long-term debt rule that we are hopeful it would have made a difference also is that uninsured depositors might have less incentive to run in the first place if they know that there's long-term debt available ahead of them to absorb losses, and that there's less of a run for the door in that manner. So
my sense of the dialogue from people who are depositors at those accounts was not a lot of thoughtful capital structure analysis.
that may be the case.
Just a follow-up question. So, and you touched on it. Maybe it's not for the FDIC, but this question of interest rate risk in the banking book, which was kind of at the heart of this, which has been going backwards and forwards in Basel for decades, I think. If you don't have the going concern capital provision for that risk, so the UK has it under its second pillar, then how do you size the refill, if I could put it that way, to make sure that you've captured it? And secondly, I may not have heard it properly, but some of the pushback was, well, the banks don't have access to the market, so it's maybe not proportionate to ask them for that much. But if the objective is to be able to recap by writing down the loss absorbing capital, whether it's debt or equity, then in a way, I mean, you fail in that objective if you size it below that because they haven't got market access. You have to think of another way of doing that. It's just a question of being 80% of the way there in a resolution when you want to keep things open doesn't necessarily, I mean, getting close doesn't necessarily help. You kind of need to size the refill properly. And the last question was on this question of retail investors, which is absolutely terrifying. If you have to do a resolution and write down retail investors, you won't. I mean, politically, you just won't be allowed to, I think. Certainly in the UK, you couldn't do that. So the sale of TLAC to retail investors is prohibited, I think, or conditioned by the what would be the SEC rules in the UK. So it's actually not done by denomination. It's done by the rules around sophisticated investors versus non-sophisticated investors. And that's probably a better way to do it. Okay, you have some definitional issues about where you put the cut between those two things, than trying to make the sum so large that only very rich retail investors could get there. Have you explored with the other? I assume it's the SEC in the US that would do this. Have you explored the other route, which is basically a kind of regulatory route between sophisticated and non-sophisticated, to try and get at that denomination thing? Because I mean, it's fine if not many small investors are holding $2,000 worth of TLAC, but if that were to grow, I think that just the political pressure of trying to use it will be enormous. Sorry,
I'm just going to jump in real quickly on the question of what we may or may not have discussed with the SEC. I think given the pending rulemaking, it might be challenging for us to talk about the other alternatives we may or may not have explored. So if you wouldn't mind, I'd like to take that last bit off the table.
Yeah, that's
sorry.
I was trying to be helpful.
Sure. And with regard to your first two questions, which are sort of really, I think, both about sort of the quantum of recapitalization required, you know, I think it's always challenging to predict in advance how much will be needed. Very few banks fail with exactly 0% capital. So we do have this but we do have this idea that we'll assume that they have, especially for these banks that are subject to resolution plan guidance, that they will perhaps fail with roughly 0% capital, and then we can recapitalize them. There could be other factors that are not always perfectly captured in our existing capital requirements, like interest rate risk. That's done typically more through a supervisory function. With regard to the smaller banks, one of the arguments that the public made in their comment letters was that because these smaller banks have less frequent access to the market, then they would be forced to hold higher buffers, and that would serve as that they would therefore sort of be less able to run closer to the minimum requirement. So they would de facto end up holding more. And perhaps with that, since we are running short on time, and I want to make sure there's enough time for our guest speaker, Walter, maybe I can pass it to Pat.
Thanks. I think I have 24 seconds. So with that, I will truncate my comments a bit, and happy to dive into anything with questions. But if you go to slide 11, I think it's slide 11. And I'll be quick on this because again, it's really history. And you had the failures of SVB and the resulting failures.
Yeah, but important history, I might.
Well, it is, and I'm going to truncate it a bit only because I think people are somewhat aware. The and signature on 2 days later, and then the systemic risk exception was invoked. Now, one of the key parts of that, of course, was allowed the FDIC to complete its resolution in a manner that fully protected all depositors, including uninsured depositors. Now, one thing, and I'm going to try and channel to Chairman Grunberg's point, I'm going to try and channel him here, but probably fail. It's worth noting these, the two institutions were allowed to fail. Shareholders lost their investment. Unsecured creditors took losses, and the boards and most senior executives were removed. So again, the protection was limited to uninsured depositors, the additional protection. But the key point of this discussion, at least from my perspective, is that as a result of these actions, there was a downstream result of a special assessment that was associated with losses related to uninsured depositors. And that is that under the FDI Act, the loss to the DIF arising from the systemic risk exception requires, in this case, the case of the coverage of uninsured depositors requires that loss to be recovered from the industry. So now we're on to slide 12. And this shows the actual loss estimates as of June 30th. And the total loss and total across the two estimated at $22.4 billion. And then the estimated losses attributable to, and this is a key point, attributable to the protection of uninsured depositors was estimated to be approximately $19.2 billion. So largely the overwhelming majority, because of the amount of uninsured depositors, the losses associated were to the uninsured depositor coverage. So one key point that's important to make here is that these loss estimates have always been estimates. We advertise them as such, and they'll always be periodically updated and adjusted as liabilities are satisfied, assets are recovered, and the current estimate of $19.2 billion losses to the uninsured depositors is an increase of approximately $2.9 billion from the initial estimate. Well, the estimate at the time of our finalization of the special assessment of $16.3 billion. So that increase was largely due to recoveries from assets in receivership that were less than previously anticipated, and higher costs of liabilities assumed by the receiverships. So now on slide 13, I believe now.
Patrick, could I ask a quick question of point of information? Silicon Valley Bank had widely advertised uninsured deposits that were 90% and above, and this is distinctly lower number. Is that because measurement of uninsured deposits is inexact? Or does it reflect a sort of weakness? And it seems to me that one of the key things you need to know is the amount of uninsured deposits. And if it's really subject to plus or minus 7 or 8%, that could make a difference.
So one, we're going to talk about the RFI, which we have related to deposits, which I think will get a little bit to your point question. However, having said that, the key point here is this is a percentage of uninsured depositors at the time of failure.
Yeah.
So largely the numbers you see in the public were fourth quarter of 2022.
Okay.
And so, as you know, some uninsured depositors ran. And so this is reflected at that time. It's a combination of both points you make, and that even the number on the call report that people look to is an estimated uninsured. So it's estimated. And then the key point here is this is our view of what was actually at failure. So that's why you see both banks have a lower percentage than they.
Yeah,
they
and that simply
reported on
reflects the fact they did run.
They ran. That's right. They ran, at least in part, but there's also an estimated piece to this too.
Sorry, no, we're short on time, but a question. This is a fascinating chart. So what it shows is an extraordinary discrepancy between the losses at SVB and Signature, and factor in both SVB's larger size and greater percentage of uninsureds. That still doesn't explain the 7-to-1 differential in loss. And I'm wondering if the FDIC at this point has figured out or studied at least why so much greater loss at SVB than Signature.
I'm gonna look to Sean Connie here to help me out on this one, I think.
Well, some of these again are estimates, but I think I'm just looking at the chart right now. There's a lot of factors at play here, and these are vastly different businesses. SVB did have much more in terms of the securities, a much larger securities portfolio that had mark-to-market issues. So that's a simple one, but also just if you look at some of it's a function of what the market ultimately bid for the institution to begin with. So sometimes you see the realities of valuation when you actually put it to market, and that's kind of a partly to play as well. And it was just a more complicated, to be honest, a more complex institution, all things being equal in terms of the global scope that SVB had. And they kind of were in slightly different businesses, even though Signature was more in a CRE versus SVB as well.
And I would note, I mean, again, that historically the average loss rate on a failure, if you look back into the crisis, was I think approximately 18%. But the variation has always been extreme across. So it really does depend on the assets, the value of those assets. Again, the franchise value. There's a number of factors that play in always. Not specific to the two institutions, but certainly this isn't abnormal if you look across our history of failures.
Right, and I think franchise value is a critical component here and needs to be part of the resolution plan, critical part of the resolution planning.
Yeah, absolutely. I mean, just even identifying the franchise values is what are the franchise components that you could value, and are they actually marketable? I mean, can you separate them and actually realize valuation or a value for it when you actually put it to market? So those are the things that we definitely faced during 2023, and we're looking to solve for with this rulemaking.
Okay, so on to slide 13.
Could I ask one question?
Sorry.
This does go back a little bit to the earlier comment about the cliff effect and setting, what makes it systemic by size. Have we learned anything from these episodes that actually could be factored into your consideration of what makes a firm systemic, or is there some restriction in the law that doesn't allow you to take what you've learned and use it in that way?
I don't think that's for me to answer.
I would say it depends in part on what regime we're talking. Sorry, it depends in part on what regime we're talking about. If we're talking about Title I, there are some very clear boundaries that were set by Congress. And so that's not something that we have discretion to operate around. With respect to our own IDI resolution planning, we do have more discretion, and you will see in the current version of the rule as compared to the prior version, there is more of a focus on systemic impact, that's something we recognize is important. And coming out of 2023, we have an enhanced appreciation of what kind of institutions pose systemic risk.
Okay, thank you.
I would add, Tim, I think in the past, we suspected institutions as relatively small as these could still be a systemic consequence. I think last year eliminated any doubt we might have had. And I think that, the measures we're talking about here this morning significantly strengthen resolution plan requirements at the bank level for institutions of this size, and the proposal of a long-term debt requirement, which were really measures previously principally applied to GSIBs. And I think we are now moving those down at least to the $100 billion level, frankly, in recognition of the systemic risk experience we had last year.
Thanks, Marty. Yeah.
And there's a reason why they set me next to the lawyer, because I've wanted to jump in on all these questions. But anyways, and I shouldn't. Anyway, so with that if we're on 13, briefly on the special assessment. In terms of the special assessment, it was finalized in November 2023, 312 comments on our NPR. In implementing the special assessment, it provided the FDIC with discretion in the design and timeframe, but importantly required the FDIC to consider the types of entities that benefit from any action taken or assistance provided under the determination of systemic risk, economic conditions, the effects on the industry, and other factors that the FDIC deems appropriate and relevant. So pretty broad scope here. But in short, the special assessment as finalized was based on the amount of uninsured deposits reported as of December 31st, 2022. That is the last reporting period prior to the March failures, and at least some form of, for some institutions where deposits, uninsured deposits, continued to flow out. An important element of the special assessment was that while we looked at the total amount of uninsured deposits reported at that time, it actually excluded, there was a deduction for the first $5 billion of uninsured deposits. So really what this did is this excluded, of course, by definition, any institution that's $5 billion or less, but also in essence, because if you had $6 billion of uninsured deposits, you're only paying on that first billion. And really what this did was it pushed the special assessment towards larger institutions and also those institutions with more uninsured deposits. I think of them as being across two dimensions, the size and also concentration to uninsured deposits. So in general, we believe that large banks and regional banks, and this is always one of those counterfactuals, particularly those with large amounts of uninsured deposits, were the banks most exposed to and likely would have been the most affected by uninsured deposit runs, but for the determination of systemic risks. So those institutions have benefited. We also applied the deduction at the banking organization level to make sure that, in essence, if you have a bank holding company with 4 charters, you're not benefiting simply from your organization. So it applied it at the banking level to make sure that was the case. Here again, just to touch on estimated uninsured deposits. Some institutions refiled their uninsured deposits. I note here, as of some, at least in result of our NPR, but some even prior to that, of course, because some institutions looked at it and said, whoa, this is a focus of risk, and let me go and let me make sure that I'm estimating that appropriately. We've actually, we looked at those changes. We also went in and did some reviews of those, of larger institutions subject to the special assessment. And again, what we found was certain institutions, their changes were absolutely fine. Other institutions we looked at and we said that's not, that wasn't appropriate. We asked them to refile. So it was absolutely critical, not just for the special assessment, but also I think it's important to make sure that it's a risk stripe, it's a risk profile that it's important for the public to know. And lastly here, the collection period we established as 8 quarters. And that was based upon if the estimate didn't change. Now at this point in time, because the estimate has increased, It actually will shift out to up to 10 quarters. Not a full two extra quarters, but up to 10 quarters. We're updating institutions quarterly as those loss estimates increase. If it were to drop again, of course, it could be less than 8 quarters. But one thing that we are required to do is to collect the entire amount of the loss, whatever that loss might be. I'd also note that the 8 quarters was designed to do a couple things. One, it did require institutions, once we finalized the rule, to take a hit to income that quarter. So that quarter, the initial estimate, institutions took a hit to their income at that quarter. But paying it out over 8 quarters allowed more liquidity planning and also allowed more time for the estimate to firm up. And we think that was important to make sure that the estimate won't necessarily be finalized, but would be closer to final. So now on to slide 14. And this goes to going back to the uninsured deposit question and comment. We put out an RFI in August that asked for requests for information from the industry regarding deposits and largely uninsured deposits. One thing I would note here is that there really is one. I always simplify it. Some people would tell me I'm oversimplifying it, but there's really one line item that's buried what I consider deep into the regulatory reporting, the call report of the banks, and it's called estimated uninsured deposits. There's a few other line items that matter and do for all banks, and I know there's other reporting regimes for certain other types of deposits, LCR and things. But this really is asking for information from the industry for us to better understand the stability, the potential characteristics of different types of granular look at deposits, to explain how these might have demonstrated stability and how they might have different characteristics. Also, we're hoping to get information out of here of what would be appropriate if we were to ask for more granular information on deposits. What would be best for us to ask and how to ask, and what would banks be able to report? And lastly, we talked about this last SRAC, our options for deposit insurance reform paper that was out at that point in time had explained that one thing we think would be helpful would be for business payment accounts to potentially receive additional coverage. One thing we've asked for in the RFI is some information around that and how banks would think about that, how they might, banks and the public, how they might think about that, they might think that would be defined, and how they could in effect report. Because one thing we didn't try and do in that paper was actually define business payment accounts.
So, Patrick, I just wanted to say, I think the RFI is most excellent, and it is a great example of the kind of collaboration with the banking sector that Rob was talking about in the development of Ireland. So it's great that it went out as an RFI. I note that also in the final IDI rule, you've also increased information on deposits. So I think it's going to be very, very interesting to see what comes back here. Certainly, this is one of the big lessons learned. One point that might make sense, and I think you're probably already focused on it, is there is a distinction between uninsured deposits and then muni and county and state collateralized deposits, which is something that a lot of folks didn't pay attention to until 2023.
Right. No, that was one of those points where it actually still is uninsured, but from the depositor perspective, they could think of, and they could have very different characteristics, and we received those comments.
You're going to be very, very interested to see the results of this RFI.
Absolutely.
It's really important.
Yeah, you're not alone.
Yes.
Historically, the FDIC, I'll confess, was mostly concerned about insured deposits. We now have an increased interest in uninsured deposits, and hopefully this RFI will give us greater line of sight into that.
Could I just ask a question? So what the sort of 23 incident showed was business model risk, basically. What's concentration of your liabilities, concentration of your asset base, etc. And that some firms have much higher risk profile just because of the nature of their business model. What tools do you have as a resolution authority when you see the higher risk? So information is good, but if you see there's a big concentration here, do you have the freedom to adjust liquidity regulation for resolution? I guess you can't adjust loss absorbing capital because you're sizing that on something else. But if you start to see, look, this institution has a higher risk profile, we may wind up dealing with it one day. How much of your structure can you adjust to reflect that?
It's a good question.
Well, as a supervisor.
No, as a resolution
Right.
supervisor, I understand. But
And which is more upstream, but to me, resolution's too late, but you guys answer.
So in some of our liquidity planning that we've tried to espouse principles of thinking about what your needs could be. So it's not that your need is X. It's not a prescribed percentage of a deposit type or an asset type that might leave. It's meant to be geared toward your business activities. And so if an institution has something that is more volatile, has something that is more susceptible to a significant change or significant run, that should all really truly be built into their planning as to how much they need to have set aside. And it could become a function of the trigger system. It could be a function of development of alternative solutions. If plan A doesn't work, how about plan B? So I don't know we've enunciated it quite in those terms, but I think the principles are still incorporated in our liquidity expectations.
So basically you could look to them to hold more liquidity, or you could set the trigger a resolution at a higher point in the.
I don't know that we would set it, but we could look at their trigger system and think about how are they setting their triggers and is this reasonable? We're not trying to create the resolution plan. Again, the firms are writing their own resolution plan, but if we thought that what they were designing would not work, that would be our responsibility would be then to point those concerns out.
It's natural for them and the FDIC to think about the banking system specifically, but you should be thinking about systemic stability as well. And in the payments issue, if a company can't put its payments in the bank, it'll go to a money market fund or repo market or something like that, which has its own run risk, for example. And so let me just add my voice to having some kind of parallel thing that's similar to a money market fund with maybe some additional collateral, some fees, and so on, that is protected maybe by collateral rather than by the FDIC, to allow companies to put large amounts of money for payroll purposes, et cetera.
Could I just ask, I'm listening to the conversation. I just want to come at it from a slightly different perspective. Since the events and all the actions that we've been taking, the FDIC has been taking, have there been any unintended consequences that have surprised you, either taken by the institutions themselves or the depositors? Like, what has changed in terms of business behavior post the event and the inquiries that have been made? Did anything surprise anybody, or has anything changed?
Can I jump in on that one? Because one of the things that did surprise me was the growth in reciprocal deposits. This is a mechanism by which you can reduce the amount of uninsured deposits you have if you're nervous about an institution. So it was helpful in stabilizing some of the institutions that were struggling last spring, but it also expands the FDIC's deposit insurance in effect. And so I was curious, in your RFI, is that one of the things you're trying to understand better? Because that has been growing not only in the United States, but I also understand over in Europe.
Right, and it's, I'm trying to remember if we have something specifically on reciprocals. I'm not sure, but to that point on reciprocals, the growth was a lot of increased growth off a low base over that, again, first couple quarters. It's leveled off and plateaued a bit. And again, I don't know if that's surprising or not. And certainly there's concentrations, it's not spread across the industry though. So even looking at that simple average doesn't really paint the picture. And again, reciprocals is something institutions can benefit by. I mean, from a supervisory perspective, we just have to look at the concentrations there. I mean, that's my take on it.
Yeah, I would add that in my view, from a supervisory perspective, I have seen institutions, well, maybe not actively borrowing at the discount window, recognizing that that's a viable option and thinking about the importance of having some mobility of collateral, or even starting to put collateral there to strengthen their alternative funding sources. So that's a favorable thing that's come out of this.
So just, this is anecdotal and you may know, I think you probably do. I would have assumed that category 2, 3, 4, the percentage of uninsureds has declined significantly since 2023.
I look at the aggregate, and I mean, one thing, I just speak to the aggregate, and then you all, I mean, and it's, I think it went from a peak of approximately 47%, depends a little bit how you wanted to measure it, but down to 40%. It's really leveled off at that point in time, approximately 40%. So, I mean, one thing that maybe surprised people, it still remains, at least in aggregate, at a very high level. And yes, that's a decline. Some of that happened prior to 2023 as the effects from the pandemic, kind of wore off. But so, I mean, I think that's something that maybe I would have expected to continue to decline, and it's really leveled off. And yeah. In aggregate, by the way, yeah, institution by institution, yeah.
Yeah, I was just going to say, so I think there has been research published recently looking at the reciprocals are most common in the sort of under maybe 10 to $100 billion range. And we haven't seen quite as drastic change in the balance sheets of the categories 2, 3, and 4. With that being said, I'm being informed that we had built in some buffer time into our.
Yeah, we've lost that.
Yeah.
But why don't we, because we could go on this subject, I think, for a while. Let me say this has been a terrific conversation, and very much the comments have been very helpful. If I may, let me turn from the U.S. regional bank failures to a European episode, and introduce our guest speaker, Stefan Walter, who, as I mentioned, is the Chief Executive Officer of the Swiss Financial Market Supervisory Authority, or FINMA as it's known, to discuss the efforts in Switzerland to learn from the experience of Credit Suisse, I think both on a supervisory and resolution policy basis. As many of you may know, Stefan was appointed in April of this year by FINMA's Board of Directors and ratified by Switzerland's Federal Council. Just prior to his service in his current position, Stefan served as the Director General for Supervision with the European Central Bank. His responsibilities included supervision of the largest Eurozone banking institutions, including the Eurozone's global systemically important banks. And prior to that time, which is when I first got to know Stefan, he served as Secretary General of the Basel Committee on Banking Supervision from 2006 to 2011, and played a critical role in the post-crisis regulatory reforms that were implemented. And prior to his service at the Basel Committee, Stefan served at the Federal Reserve Bank of New York, including as Senior Vice President responsible for supervisory policy, financial analysis, and financial stability. So the Swiss did well. They managed to recruit an extraordinarily able and experienced person to take over the regulatory authority. We really appreciate Stefan's willingness to be with us today, and in some sense update us on where things stand in Switzerland now and the lessons learned from last year's experience.
Thanks a lot, Marty, and thanks for inviting me to this advisory committee. And it's great to see so many colleagues from various venues in the past. I'll try to, as you said, provide an update. Can you hear me? This,
I think just get a little closer.
I'll get a little closer.
Yeah, there you go.
Okay. I'll try to provide an update on the situation in Switzerland, on not just resolvability, but also the supervisory lessons learned, as you said, because we're an integrated supervisor. We have both resolution powers and going concern supervision. So I would like to talk to both. There's some slides, I believe, in your pack as well. So I'll mention think we'll start with slide 2 and give you a little bit of a retrospective. The Swiss too big to fail regime leading into the crisis, there were key cornerstones put in place following the 08-09 situation, where it was UBS was the institution that had gotten into difficulties at the time following the GFC, and that resulted in a number of requirements, such as having a clean holding structure, bankruptcy remoteness for corporate service entities, also having the Swiss entity separable, and that's where most of the systemic activities are housed. And then, of course, to build up the loss absorbing capacity, the TLAC, to handle a bail-in. And in addition, there were additional liquidity requirements beyond the Basel standards, which were quite helpful in handling the first wave of outflows in October 2022, but of course then weren't sufficient for the second wave in 2023. And I think because of these preparatory investments, there were two options available at the time then in March 2023. The first was the single point of entry bail-in restructuring option that was ready to implement, and thanks very much to a lot of collaboration that took place well in advance with the members of the crisis management group to prepare for the ultimate March situation. So that was on the table, and also thanks to the close collaboration with a lot of people at the FDIC who are also involved. The second option, the takeover of CS by UBS, which turned out to be the option that was pursued because it was seen as the least risky of the two. A resolution of a global GSIB had not been tested yet globally, so when there was the possibility for a takeover via UBS, that was the option that ultimately was pursued. I think it's important to highlight both options. See the full write down of A Tier 1 instruments, and both options required a large amount of liquidity in the form of a liquidity backstop, which was provided through emergency legislative powers through the Swiss Federal Council, as no such instrument had been prepared in legislation before, which is of course one of the big lessons learned coming out of this. Since then, FINMA and the Swiss Federal Council released their lessons learned reports, and I'd like to get it to present some of those thoughts to you. I'll focus on three areas. The first is really from the supervisory side, so on a going concern basis, trying to reduce as much as possible the probability of a failure. Second, then getting into the resolution topic, bringing down the impact of a failure as much as possible, and then I'll end with a few thoughts on international cooperation and coordination. So turning to slide 3, starting with reducing the probability of a crisis. Of course, the best is to prevent it in the first place, and that really requires focusing on the quality of the management in the institution, first and foremost, who should be responsible and have the incentives to be responsible. Second, the need for enhanced supervisory powers, and then also strengthening forward-looking effective supervision based on some of the lessons learned. One of the key things is indeed further expanding the powers to supervisors and making sure that those are comparable to what you have in the US, the UK, and the EU. And probably the most important is the early intervention powers and being able to have the full toolkit available in going concern, and not that it starts becoming available as as you start slipping down, going into more recovery kind of mode, because it's pretty clear that things start with problems in risk culture, governance, and business model, and then only later do you start seeing losses, and even later do you see impacts on capital and liquidity. And you can even have a situation where an institution hits the point of non-viability before the minimum capital and liquidity thresholds are hit. And so that's why it's so critical to start at the top of the food chain as much as possible. Second, and this is a little bit of uniqueness in Switzerland, important to have even more focus on direct supervision and less focus on external auditors because of some of the inherent conflicts. And it's just important supervisors are in there, in the guts, down and dirty, all the time. Third, introduction of a senior managers regime, something we envy the colleagues from the UK for, because it can assign responsibility to individuals and make it easier to remove people earlier if they're not meeting their responsibilities, and can have a very preventive effect as well, because if you link it also to the bonus, for example, then it focuses the minds. Fourth, naming and shaming. So being able to publish enforcement actions. Right now, it's sort of the exception as opposed to the norm. It should be, why don't you publish, instead of why do you publish? Fifth, fines. Imposing fines on institutions also can have a sort of a discipline effect. And sixth, having very clear powers, not just in the Swiss entity, but for the whole group, on resolvability. If the business model starts going in a direction that stands in contradiction to resolvability, then you need to have the power to intervene and stop that and force changes in the structure. And so these powers are covered in the Too Big to Fail report, and so that's why it's very important that that report be translated into legislation as soon as possible. Then within those powers, of course, important to take the lessons from also a supervisory perspective. And here, I think one of the big lessons is really these qualitative elements I referred to before, and continue to deepen and enhance our toolkit to be able to assess weaknesses in governance and make that more tangible. What are the red flags to intervene? Weaknesses in risk culture, and make that also more tangible in when one can intervene, and also identifying business models that are increasingly unsustainable, and here too strengthening the supervisory toolkit. Also, we're increasing our resources, in particular for the supervision of UBS, the much larger, of course, merged entity. Then turning to slide 4, reducing the impact of a crisis. So here it's critical to do further work. In Switzerland, we're now talking about one global GSIB instead of 2, and we also have 3 domestic systemic institutions. One is to strengthen the resilience in periods of stress, including recoverability. In the case of UBS, the systemic add-on will grow simply by the size, and then that triggers increase in the add-on. Second, it's important not just to focus at capital at group level, but also the distribution of capital in the group. So in particular, the parent institution that holds the major subsidiaries, especially the international ones, and to fully capitalize the holdings in those subsidiaries, so that when you sort of get into this pro-cyclical cycle of losses hitting capital, if you fully cover that up front, then you don't have that knock-on effect, which can become an impediment to resolvability and recoverability in periods of stress. Further work on liquidity requirements. The discussion already took place about how the world has changed on the liquidity front. This is primarily a topic, though, for the Basel Committee. And then lastly, strengthening the recovery plans to make them even more realistic for periods of stress, and to really test and challenge those, because the assumptions of institutions can be a little bit rosy, and those really need to be, kick the tires on those in good times. Then turning to slide 5 on the resolution topic. So we're very much focused on enhancing the resolution planning of UBS, since the bank, of course, is very large as a percentage of the economy. Now it's smaller than what the original UBS was in 2008, but it's bigger, of course, than Credit Suisse alone. And so the SPE strategy remains the preferred strategy, and it's important to further work on that, and in particular to make sure that the integration work moves as fast as possible, so that one has integrated data for the whole institution, as opposed to kind of two pieces of information, which obviously complicate things like valuation and data rooms, and just the quality of the information in a resolution scenario. But that's something where we came out today saying that the institution needs to make improvements, but there are workarounds for the interim, even though one wants to get to the final state. The second is increasing the optionality for a resolution situation. So here, the focus is not just on SPE sort of reconstitution and continuing with the institution, which is probably something best for an 2008 type UBS situation, but also to have the option of a market exit scenario, which is a situation where you may have a fundamental loss of confidence in the business model and the reputation of the institution, and therefore want the ability to be able to sell key parts, and then the other parts you can't, to be able to wind those down in an orderly way. The third option is a sale or merger of the institution in resolution. That's obviously not a Swiss option, but would be a global option, and also important to continue fleshing that out. And so the Too Big to Fail report fleshes out how to strengthen the foundations of these different initiatives, and in particular also for the last two additional options, to make sure that they are that the legal foundations underpinning those are as robuster than what we have now, and that you then have these three kind of core approaches, but there may be variance between them, and how you might mix and match, because you can never predict exactly what will happen. All options also require strong liquidity support. So another key part of the package is the public liquidity backstop, and to turn that into legislation and something that's in place ex ante and doesn't require again an emergency type action. Another element is having maximum flexibility is to have a bridge bank option. I mean, it's in there, but it's not really fleshed out and elaborated, and so it's very important to establish that option. Also, give it more structure and legal certainty for a bridge bank type solution. Therefore, making all these options even more executable. For example, situations where you may need to buy some time, and that's where a bridge bank can be particularly important. And then the last slide, just to conclude, the really importance of
the slide you just finished, bridge bank versus clear holding company.
A clean holding.
Okay, it's a typo.
Oh, sorry.
So
the idea is, I mean, there is already a clean holding company requirement.
Yeah, no, that's.
But having a bridge on top of that can create even more optionality. Although the more clear it is, the better too. And then on international collaboration, that's absolutely critical and something we want to deepen even more. And I would just add that with one GSIB, we don't have, the peer perspective, and so it's really important to learn from others on what are best practices, and also possibly to be an observer on one or the other additional crisis management group. Is, I think, in everyone's interest that we really bring together the best practice. So I guess that's what I would say in terms of opening remarks, and really look forward to a good discussion on this important topic.
Stefan, if I could just jump in. As you know, I've got a little bit of interest in this. I was an executive at Credit Suisse back in the aughts, so 15 years, sorry. Hi, Stefan. Thank you for that. And as you know, I have a more than passing interest in this. I was an executive at Credit Suisse during the aughts, so long time ago, just for clarity. But read all this stuff with extraordinary interest. I think the Swiss have done some great reports on what happened. For example, the financial stability report that detailed the liquidity support that the SNB had to put forward was, I thought, extraordinary. Basically priming the balance sheet of Credit Suisse and providing pretty much all the short-term liquidity needs of the institution during those last days, which I think is an important end game to understand. I think it's something where all the resolution authorities I'm familiar with, possibly with the exception of the Bank of England, which is more integrated, have an interesting dance between the lender of last resort and the resolution authority, and getting that right is extremely important. There was an external report by Sir Paul Tucker that looked at the lender of last resort features in Switzerland, and although it was very constructive, I think, in many attributes, also had, I think, some critical elements thinking through the extraordinary liquidity needs of our largest institutions is something that may not have been fully comprehended yet. And I wonder if that's something that you feel is underway. Is a cooperation between the resolution authority and the central bank advanced enough in your view? And if you have also any general ideas about how that's proceeding in the international context, because this is not a Switzerland only problem, that is a general problem for all resolution authorities.
Yeah, no, I think what's key is, I mean, there are three key players. It's the FINMA that's responsible for determining the point of resolution. It's the Swiss National Bank, which is responsible for liquidity, ongoing emergency liquidity assistance, and then also, providing liquidity, possibly, guaranteed liquidity. And then there's the government, which may have to step in with guarantees. And so all these bodies are in an emergency council to coordinate. And one of the topics that's being reviewed as part of the lessons learned is the collaboration and how to strengthen and make that more effective, among the three entities. The other topic you alluded to is making liquidity available, and so that's not something enough to just think about it at group level, but need to think about it in the different entities, both domestically, but also internationally. And so one of the key elements of preparation is making sure that not just capital is distributed in the right places, but that the capacity to raise funding is distributed as well in an appropriate way across the group. And so that's definitely something that is one of the key lessons learned and one of the areas of focus. And in the CS, you didn't have the liquidity necessarily in all places where it needed to be.
Can I just come in on the so when you put the lender of last resort and the resolution authority into the same institution, you internalize these issues, but you don't take them away, if I can put it that way. But you do come to an interesting point, which I sort of wondered, and I remember some of the interactions between FINMA and the SMB prior to Credit Suisse. If you think about the public sector as a whole, it's quite difficult to tell depositors and others that this bank is now in resolution or whatever and is safe and you should fund it, but the central bank won't. And that's where the central bank looks at its balance sheet and says, I don't like the risk in this. And the resolution authority says, well, we've taken it into resolution now, we've recapped it, because you know that if you take something into resolution, if you don't go the UBS, the route that they went in the end, that the market won't lend to it on the Monday morning, and the public sector will have to lend to it until the market gets confidence. And I just wonder how in Switzerland you solve that to some extent. The Bank of England is able to do that to some extent because it gets a government guarantee. So there's the public sector backstop sits inside the system. But if you don't have all of that worked out in advance, you could spend a lot of time with the different objectives of the different players, just creating a friction while liquidity is leaving the bank. And the second point is even if you have a public sector backstop, you need to distinguish that to some extent from ELA, because you're no longer in ELA to a going concern that's failing. You're now in liquidity to something that's in resolution. And that requires, to some extent, the creation of a special instrument that recognizes this is not ELA and this is not, if you like, a bailout. And I just wonder how in Switzerland you're now going to organize that so that that's all set up in advance. Central banks, I know, can be very prickly about their balance sheets. But to avoid these kind of objectives, which go in, basically the institutions have different objectives, how it goes in a crisis. I'm not suggesting you put it all in one institution. You have some interesting conversations inside the institution when you do that. But
I mean, I think you hit on the key point. You need the capital, you need the liquidity, and in the extreme, you may also need a public backstop for for this to come together on Monday morning, and you need strong coordination before you get to Monday morning in terms of the liquidity, I think that is something which is one of the key focuses in the Too Big to Fail report. How to make sure that works as best as possible leading up to the situation, and it's absolutely critical. That's why there's this need for the legislation for the public liquidity backstop to provide the liquidity throughout the whole process, irrespective of which of the three approaches that you choose. So yeah, you hit on the key issues. You have it internalized. There are many models, of course, out there how these elements are set up. The U.S. has another model, and has a process for how the decision is made, which is discussed, I think, nicely in the Blue Book, for bringing those elements together in stress and what are the different considerations. And that's a topic for discussion going forward.
Yeah, the only point I make is it does help to set it out in the purple book in our case, just in advance, kind of how it will work and what the rules are and what the objectives are. Because then it's something you can appeal back to when you go through this. I'm not sure what colour the Swiss book would be.
I guess it would be a red book, maybe
Red and white
with a little white cross.
Stefan, if I may, there was also some interesting discussion, and it was reported in the FT about the legal certainty around if you had to go into the TLAC stack, the bail-in bonds. Obviously, you impose losses on the COCOs, which I think was very helpful in solving any risk of a capital problem. But if you were to go into full SPOE bail-in and in effect convert the bond structure into equity, that there might be some U.S. securities law issues. Have you been able to kind of work through that now that we've got hopefully a chance to catch our breath to make sure that's all been sorted through, or is that still a process that's underway?
I mean, you're right. That is just the cross-border certainty of bail-in is one of the key topics, and one of the key elements of that is the when you convert debt to equity, then you have registration and disclosure requirements, and how those could be met over a weekend versus the process. You need to go through an orderly process, and whether there can be an exemption or not, and or other workarounds is something which is still being worked on.
What I've got to say on this one, I actually think the commission should be able to reach, without exemptions, without ad hoc decisions, a clear decision, which I think is the right legal conclusion, that no further registration or disclosure is required, that it just happens. Every holder of these bonds was told at the time what the possibility was. There are a number of law firms that gave opinions on this, and I don't think any that did not. So this really requires the commission to step up to what I think is the correct legal as well as practical analysis.
The commissioner is the SEC.
Yes.
I was given the responsibility of timekeeping in particular because our esteemed panel has been at work already for 2 hours. I wanted to look to the chairman just to see, we originally foresaw an additional 10 minutes or so of discussion with Stefan. Would you like to take a break now and then come back to conclude? How would you like to proceed?
I was going to suggest if there are any, we can take another 5 minutes if there are any other questions for Stefan. If not, we can just go to a break now, but I didn't want to cut the discussion short.
May I follow up on Raj's point, which is a little troubling? It appears that the SEC was not part of the crisis intervention, and I don't know this, I'm just conjecturing. Have measures been taken to ensure that the SEC is kind of on board with all of these things? We don't usually think of it as a bank supervisory agency in the least, but it does make rules that do have an impact. And I wondered what changes have been made at the international level and kind of trying to anticipate these frictions before they become a real issue.
And all I can say is, our focus is going to be, that all relevant players are part of the crisis management group. And I think now with the with the merger, we need to look at, okay, who are all the relevant players for this new merged entity? And I think, we need to play out not just the systemic aspects, but the legal aspects as well, as best as possible beforehand. and do everything we can to have as much certainty in place beforehand. I do think it's fair to say that, a lot of discussions took place also in the other, in the Credit Suisse situation. Everything was done to make that as viable as possible under the situation there, and also talking with the relevant people.
Just to be clear, because I really want to emphasize the point that Raj made, and Raj, you made it last year as well. Every single U.S. experienced capital markets lawyer was surprised by the SEC's interpretation. So I think it's important that this group, and certainly last year, the international representatives, don't think that we're dealing with a binding law or a regulation. We're dealing with a position that was suddenly taken that was a surprise. So it should be able to be solved.
Can I jump in? It's okay. Just to say, I agree.
Sure.
Agree with what Meg said. I agree with what Raj said.
Just identify.
Oh, it's Jay Clayton, a member.
Yeah,
of the,
Jay, please go ahead.
Yeah, okay. I agree. This is a pretty easy one to reach.
Jay, could you speak up a little bit? The sound is a little soft here.
Sorry. Hopefully this is better. I agree. This is one where it's fairly easy to provide guidance by the commission, as Meg said, but also going back to what John said, which is very important, that we're in a new era where, whether it's COCOs or something else, the capital markets are going to be part of any resolution. And we should resolve these issues of securities distribution now, not in the heat of the moment.
Maybe I'll make 2 quick points on this. One,
just identify yourself.
I'm sorry, I'm Ryan Tetrick with the FDIC. One, this is a issue for a so-called open bank bail-in approach where the bonds are directly converted to equity. And I'll just observe in the U.S. Bridge bank approach, we don't have the same securities law issues. So that's explained in the paper, but it's worth observing. But I agree the issues should be solvable. And I'll just note that this is an issue that's gotten considerable attention since the events around Credit Suisse at the Financial Stability Board. There's been a lot of focus on it, and the SEC has been intensely engaged in those discussions.
If there was not a keen awareness before last year's events of the critical role of securities regulators in these kinds of resolution situations, I think there's a keen awareness now. Anyone else? Let's take a 10-minute break and then come back.
Talk.
I also think Stefan's presentation was a nice transition to our next topic. We heard about the Swiss efforts. Now we can talk about the U.S. Let me turn it over to Art Merton to lead that conversation.
Thank you. Thank you. Yeah, we're here. We're going to talk about on this panel about our blue book that we put out in the spring. And we're going to talk about what's in this, but then also talk about, get your guidance or advice on how we can engage with market participants and other important counterparties, not only before resolution, but in the moment to be most effective. So I'm joined by Ryan Tetrick, a Deputy Director in the Complex Institution Group. Joanne Fungaroli, a Senior Advisor, Susan Baker, and Penn Stark, Deputy Director in Legal.
Okay, thank you all. As I'm sure you are all, one of the key ways that the FDIC can support stabilization and the resolution of a large, complex financial institution is to set expectations in advance, as we've been talking about, so that when stakeholders know what to expect, and when the FDIC can actually do what we've said we're going to do, it hopefully will help to calm markets in the moment. In our 2022 SRAC, which was also in this room, we asked for your feedback on key items that the FDIC needed to be more transparent about to improve our understanding. We discussed a list of key stakeholders who would benefit from transparency. We discussed what they needed to know. And the result of that work, or feedback into this, is this paper, which we published in April, called The Overview of Resolution under Title II of the Dodd-Frank Act. Oh, wow, we have slides. With this paper, we aim to help stakeholders by providing clear information about our Title II resolution plans with an additional focus on US GSIB resolution. So the paper seeks to anchor expectations, and we hope that will support financial stability. We also want to make clear what will happen to key stakeholders. Shareholders and creditors will bear the cost of the resolution, not the taxpayers. We want single point of entry, means that the key subsidiaries will remain open and operating, and customers will have access to their deposits, and that we have plans in place for operational continuity. And we also hope that this paper demonstrates that the FDIC stands ready to undertake an orderly resolution under Title II if we're called upon to do so. And I will spend a few minutes talking about the content of this paper and what I hope to receive feedback on whether the transparency provided in this paper hits the mark. Are there other areas that we should be striving for more transparency about? And there is a balance here, between easy to understand language about this and just the inherent complexity system that we've built to address these issues. So I look forward to your feedback on whether we've struck the balance in the right way. On the next slide, I'll start in. The paper begins with an overview of the challenges of resolving a large, complex financial institution. This is shown in this graphic down the left-hand side. And then provides a detailed description of the resolution tools and policies and plans that have been developed to address those challenges. The key elements of the policy and planning infrastructure that we explain in the paper include, obviously, as we've talked about it a lot, the development of the single point of entry strategy, but also the policies that are needed to make that strategy feasible. And that includes external and internal loss absorbing capacity, pre-positioning of liquidity, the clean holding company rules, and the QFC stay protocols that are all necessary to making a single point of entry really work. We also highlight the benefits of Title I plans, which the GSIBs have developed, through which they've developed capabilities, governance frameworks, simplified organizational structures, and the things that they need to organize themselves for resolution under the bankruptcy code, which is a hard standard, as our colleague Judge Drain has reminded us. We've also covered ways that we've worked to address cross-border cooperation, which Joanne is going to elaborate on later in the panel. So on the next slide, we go into having set the stage with the infrastructure in the paper with the infrastructure that we've built. We start to walk through the set of actions that we would need to decide whether, when, and how to use our Title II authority. And this decision making is one area where the stakeholders have always asked us for more information and more transparency. And while we cannot give absolute certainty, each case is decided independently and will be facts and circumstances dependent. We do provide transparency on the decisions that need to be made, the key statutory factors that are involved, and importantly, the information that we would be relying on to inform our decisions. So in this section of the paper, we kind of break it down into 3 areas. First, we talk about the contingency plans that the FDIC would be, the contingency planning that we would be doing as the firm enters stress and starts to implement its recovery plan. Then we review how, as the firm enters the runway to failure, we would be determining which resolution framework would be most appropriate. And the paper lays out the statutory factors here that the U.S. authorities would be considering, including whether the Title I plan for resolution under bankruptcy would have a serious adverse impact on U.S. financial stability, and then also walks through, if we need it, the multi-agency process we call turning the keys to launch the resolution. If you don't know about key turning, there's a nice graphic in the paper. The third section of the decision-making process is confirming the resolution strategy. And I will not say that this is sequential. How Title II would help, what the tools that Title II would bring to the table are part and parcel of determining whether or not it's the right resolution framework to use as well. So, I think the important thing that the paper does here that's new, a little bit new and forward-leaning, is that we clarify that for a Title II resolution of a U.S. GSIB, we think the SPOE strategy will be most suitable for a wider range of potential scenarios. And I will come back to that in a minute. And I hope that this paper helps to provide some confidence that the U.S. decision-making on whether, when, and how we would use Title II authority is thoughtful, that it builds on data, planning, governance, and the policy infrastructure that we've built in advance. So on the next slide, I'm going to just spend 2 minutes expounding on the single point of entry resolution strategy. It sounds pretty wonky, but to me, I think improving public understanding of how the single point of entry strategy works is one of the most helpful things the paper could do. Because as you all know, when you do a single point of entry resolution, the material subsidiaries transfer over to the bridge and remain open and operating. And if markets can have more confidence and more understanding about how that works, hopefully that will mean a smoother effort. And as you know, also, I think it's important to know that while the assets get moved over to the newly established bridge company, the shareholders, the TLAC holders, and other unsecured creditors are left behind in the receivership to bear losses, and they need to know that. And then also, I think the last part of this system that makes it work is that we have the OLF to help provide liquidity to the bridge if it's needed. So the beauty here really is that everything stays open and operating, or the key aspects of the firm stay open and operating, and that customers will have full access to their deposits. And we hope that this will not only stabilize the firm, but the financial system as a whole. So next slide. This is the very, very quick version. This last slide is the last half of the paper, which is really our the meat of our attempt to provide transparency about all the things that we've done and what our expected approach would be to implementing a Title II resolution. We use the example of a U.S. GSIB. So we hope that this detailed account of what we expect to do helps provide confidence that we've adequately prepared to take on this challenge. We break it down into 3 sets of actions that I'll say happen at the same time. First is the launching the resolution packet. And that involves establishing the bridge financial company, appointing new officers and directors who, like Tim Myopoulos, will be pulled from our pre-screened CEO roster, and then also starting the claims process. So that's the first bucket. The second bucket, although it pretty much starts also right from into resolution, is the things we do to stabilize the operations of the bridge. And so that includes moving capital and liquidity down to the bridge, and from the bridge to the material entity so that the subsidiaries remain open and operating and continue to provide critical functions and services. And also a key part of stabilizing the operations is our public-facing communication, which starts upon entry and which Ryan is going to talk about a little bit more later. And then finally, the paper goes through the things we talk about, the things that we do to prepare the firm for exit of resolution. So we'll be restructuring the company to address the cause of failure, undertaking orderly wind down and restructuring processes. Our goal is that the successor entity or entities emerging from the bridge will be smaller and less systemic than the failed GSIB was coming in. We also describe in this last exit session how we would use our securities for claims process to return the restructured firm to private sector control. Now, there is a lot of detail in this last half of the paper. I can't believe I got it down to 1 slide. But I do hope to hear your feedback. Would be wonderful on whether the topics covered are enough or the right ones to instill confidence in our ability to undertake this if called upon to do so, and what else we can do to improve transparency going forward. Before I turn it over to Joanne to talk about cross-border cooperation, I just also want to give a word of thanks to all the people who worked on this paper. There were many. And I hope that also gives you confidence that this is a group-wide effort that all of us are on board with. And this has been a lot of work that has gone into building the infrastructure for making this happen if we have to use it. Thank you.
Susan, I realize this is a pretty minimal standard, but I think you've produced a really good teaching document.
Thank you.
Because this stuff is very hard to present to a class in some digestible form. I did have a question about slide 21, which is simply because you're writing something very compact, but it ends with SPO feasibility improved if firm has sufficient resources to recap subsidiaries, which leaves hanging the important question, what if not?
We talk about in the paper, we did, as I mentioned, we did lean into single point of entry as our we expect it will work in a wide range of scenarios, and the firms are set up for that, and we have all the policy infrastructure in place to make that work. But if there's not enough to recapitalize, enough resources to recapitalize the subsidiaries, obviously they can't stay open and operating. So we do talk about cases where SPOE would not be feasible in the paper. That's not our primary situation.
Right, because it means something's gone quite wrong earlier on.
Right.
Which could happen.
Yeah.
But that's sort of what undermines the whole thing. People will be wondering, do they really have enough resources? Does the FDIC really know enough to know whether they do? What if?
Mm-hmm.
And I was just thinking at the time at the time you move things to the bridge, that strikes me as the key moment for that kind of communication, because if you say these are open and operating and well capitalized, that's a big statement. Yeah. And what communications you prepared around that moment to assure people that they're either in or that one or two of them didn't get the lucky ticket and are left behind.
A conventional wisdom is that this will work if there's one firm that's idiosyncratically in trouble, but it wouldn't work if there are a bunch of firms because of the effects on asset prices, the lack of buyers, et cetera, et cetera. I haven't read this. I didn't realize I didn't get it, I don't think. But anyway, do you talk at all about that contingency? That's my main question. Something which I'm not quite sure of. In the original legislation, I think there were limits on the amount of backstop liquidity, and there were at least some people concerned that those limits were too low in certain circumstances. Am I correct about that? I may be
So,
mistaken.
oh, go ahead, Penn.
More money is always better, but yes.
So the backstop liquidity is key to the asset size of the institution, and it's quite large. There's sort of two calculations. One's the quick and dirty calculation is 10% of the balance sheet.
Right.
The other is 90% of the fair value of the assets available for recovery, which is a tremendous amount of money compared to the size of these institutions. It should far exceed the liquidity needs. And that's the backstop liquidity. Each of these institutions have to have Title I plans that preserve enough liquidity to get through a resolution without a backstop, that we then come in with a pretty tremendously large backstop. And that larger amount, while the statute describes it as being available within 30 days, we would expect our peak liquidity needs are going to be upfront. And so our plan is to seek that larger amount going into resolution so that if we need it upfront, it's available.
And on the multiple.
Yeah, and even in the event of multiple failures, there is, the liquidity is based on each individual institution. So there would be a fund created in each failure. So in theory, U.S. Treasury should be able to provide liquidity resources in multiple failures.
But multiple failures would have general equilibrium effects. It would be affecting prices and a variety of things, open financial market functioning, et cetera.
I think it's also important to consider OLF has the capacity to provide guarantees, which may help.
So, but I mean, I think there's a different point here being made than just liquidity. And if there are, look, multiple failures, as we learned last year, is harder than a single failure to deal with at once. It's not impossible, but the purpose of the authority is to limit the cascading effects to other financial institutions. And if we're in a scenario where there's wider systemic effects, then other tools maybe need to be brought to the table that are beyond the capacities of the FDIC.
And also helpfully, you're not forcing these institutions to do asset sales. You're doing all this work on the liability side. Right. So I think avoiding asset sales is one of the important benefits of these types of operations.
That's a good point.
Yeah, just a couple of just on Ben's point. It's got lost now, but I remember when Mark Carney headed the FSB, he made a speech in Singapore when the rules, the standards came out. He basically said that if you're in a systemic crisis, you can't operate this system because so many other things are changing at the same time, and credit has gone completely in the system. But it may stop the point at which you reach a systemic crisis, and it pushes that point further off because you can stop the domino effect. But once you've lost 3 GSIBs, then this structure is not going to work. Which brings me to the other point, and Susan, I have kind of huge sympathy. I read this. I read the kind of not the shiny real copy, the kind of a digital copy on the way over. So on the one hand, you need to be very clear with these blue books or purple books and set it out, and you have to show there is a process and it's ordered and structured, and you have to be all in that this is going to work because it's about confidence. On the other hand, we all know that no plan survives contact with the enemy. And when you get to it, it's going to be messy and horrible. And I can understand when faced with that messiness and horribleness in Bern over that weekend, they decided to go another route. So I think I've always thought it's quite, and we never succeeded in doing this at the Bank of England. We tried, but we couldn't do it. It's trying to get across somewhere in the introduction, particularly for the public, that there is no immaculate resolution of the GSIB. It's not going to work that way. That you do have a process and you have these stages, etc. But when a GSIB fails, you have no good options. You only have least worst options. And this gives the authorities the ability to manage those for the public good. And what we did with the Bank of England, which I know why we did it, is we tended to suggest that we had this machine that we could switch on that would take a GSIB in at one end and kind of bring out a resolved authority at the other. And I always thought we should temper that in the communication because when it is messy, and as things stand now, you might have to guarantee all uninsured depositors to stop a huge run and the like. When it is messy, the confidence in the process can get eroded if you haven't explained in advance that you are actually dealing with a huge complexity here, and don't expect that, you know, the stages will follow the machine. But the tension I accept is you want to show that it'll work, and you want to explain it clearly. But there may be room in the introduction, which is written in quite kind of staid official language. There may be room in the introduction or elsewhere just to explain that we never want one of these things to fall over, and we've taken preventative action and on the supervisory regulatory side. If it does, that's a huge problem. But we now have far more options and tools than we had in the financial crisis to protect the public interest, and just bring out the messiness a little bit without. Yeah, it's not easy, but that will be my overall comment on this thing.
Thanks. Yeah, I also had the electronic version of this on the flight was longer because of headwinds, so I didn't just read the text, but then started reading the footnotes when I was running, still had a lot of time, and was looking at. Well, first I have to say it's really impressive, really impressive document, and really amazing work, and all the experience that comes into the document. But I wanted to make a link to one of the points I raised about when you have a situation when possibly so you may have the resources, you know, enough capital, liquidity, but the institution has lost complete credibility, say in the market, business model, reputation, et cetera. And there's a footnote 32. It talks about SPE strategy supports the stabilization and the continuation of the material subsidiaries, and then later that you could do the immediate wind down for certain subs that are not critical to contribute to the value of the group. The question is, what if the core subsidiaries are not valuable and contributing to the value of the group? How do you sort of adapt the strategy in that context?
So agree, there's no such thing as a immaculate resolution. And so we're going to have to adapt to the scenario that we encounter. I think the idea of single point of entry is that it's a framework that allows a lot of optionality within it. And that might be, depending on the type of institution, you know, it largely remains intact. It might be that the scenario requires certain things to be sold or wound down. And it might be that the core is faulty in some way, and it requires a longer term restructuring or a longer term wind down. We really just have to respond to the scenario. But we've, in the Title I planning process, required that institutions give us options. I think we know this is a defined set of institutions, what the likely options are for the different 8 GSIBs that we have. And we'll just have to, you know, take the scenario that we get and respond accordingly. And that might look different in different scenarios. I think one thing that's really important, though, is that any resolution starts from the point at which something has gone wrong and something has to change. So simply bailing in the TLAC and saying you're done is never going to be credible. Something has to change about the nature of the institution that addresses whatever the weakness was in the business model or whatever risk management lapses there were, to have confidence in whatever comes out of resolution. So we know there's going to be a material change, and that to some degree, we might not know exactly what those changes will be, but we have to have the broad strokes of that, I think, up front, so that there's a narrative about what's going to happen through the resolution process.
Okay, Joanne.
Thank you. I think to connect to the question that Member Herring asked about the information that the FDIC would have as a firm is facing stress or runway or potentially failure. This next segment on how we communicate with other authorities is particularly responsive to that point. As you heard Susan mention, our approach to resolution under Title II of the Dodd-Frank Act assigns critical importance to cross-border cooperation for mitigating resolution challenges. And to achieve this cooperation at the FDIC, we maintain communications with a broad range of authorities as part of our regular work. This includes domestic and foreign authorities, other resolution authorities, supervisors, central banks, market authorities, deposit insurers, and finance ministries. We work in business as usual to build and maintain our cooperative working relationships for crisis management preparedness, including by establishing memoranda of understanding, statements of cooperation, and other arrangements for information sharing across a crisis continuum, and also in business as usual. In crisis, communications with other authorities and other key stakeholders, which Ryan will talk about next, occur in rapidly developing, highly dynamic conditions, and having the arrangements in place and the relationships to support them ex ante is a critical part of our work. Our communications outreach involves working directly with regulatory counterparts at different levels of our respective organizations. As you can see today, Stefan's participation as a special guest speaker and Sir John Cunliffe's participation as a former Bank of England Deputy Governor really attests to the materiality of those working relationships at the senior-most levels of our organization. At the staff level, I can also say with confidence and from firsthand knowledge that we work daily with other authorities, both domestic and foreign, on cross-border resolution planning and preparedness. Our communications work involves ex-ante development of an inventory of potential coordinated communications for resolution execution. In addition, this planning work allows us to move quickly in an emergency, and I'll talk about a couple of examples as we progress through our slides, and we maintain this work in a multidimensional manner. So we really have two foundational anchors: our work in a firm-specific context, and then with authorities. So it's basically two prongs to the framework. In a firm-specific context, we have, as shown on the left side of this slide, our work through crisis management groups and colleges of authorities. This work involves the FDIC both as a home and a host authority. There are a broad range of groups that exist to support this engagement. First, there are colleges of supervisors, which could be core colleges, global colleges, but the purpose of supervisory colleges is to facilitate information sharing among authorities about safety and soundness of an open and operating cross-border institution. But those colleges have a central role to play in supporting crisis management response and the transition in the crisis continuum from business as usual to runway to resolution execution. The FDIC's involvement in supervisory colleges is focused on the banking sector, and it is founded on our role as a primary or a backup supervisor. Importantly, as part of this framework, we also have crisis management groups and other configurations also exist in the European context, such as resolution colleges. CMGs and colleges exist most prominently for GSIBs and central counterparties, or CCPs, that are systemically important in more than one jurisdiction. The objective of these groups is to enhance preparedness for and facilitate management and resolution of a cross-border financial crisis affecting one or more systemically important financial institutions. The members of CMGs have negotiated and adopted cooperation agreements which facilitate that firm-specific information sharing for resolution planning and crisis management response across the continuum. Our work on these firm-specific activities is part of our daily responsibility and includes co-chairing the crisis management groups for the US GSIBs, all 8, and participating as a host in a significant number of the foreign GSIB crisis management group activities as well. CMG members use our meetings to discuss firm resolvability. We share resolvability assessment information and criteria and potential mitigants to cross-border resolution execution challenges. We also share important knowledge about national resolution regimes that would be implicated in execution. This regular engagement leads to building and maintaining working relationships among firm-specific regulators who are core to develop operational preparedness for resolution execution and who are in the core of resolution execution itself. We also can quickly pivot in the CMG context from regular activities to addressing crisis response and failure planning, and we increasingly are a practice position, both as exercises and as fire drills. As of today, the members of the CMGs for the 8 US GSIBs include 16 host authorities from a dozen jurisdictions in addition to the United States. We also are pursuing work on strategies to enhance firm-specific connections with authorities from jurisdictions that are not CMG members, but that may be important to or impacted by a U.S. GSIB resolution. And that, I think, is an area of work that Stefan also mentioned as an initiative that Swiss FINMA is pursuing. For the
May I ask a
Yes,
question?
of
Do you
course.
include China in any of this?
We engage with China regularly through our work at the Financial Stability Board. They have several GSIBs that are in scope of the discussions that occur as part of the annual resolvability assessment process and reporting. But their planning is at a slightly different stage. And I would say that no U.S. authority is a member of a CMG chaired by the Chinese Home Authority at this time, to my knowledge. I also wanted to make sure to mention that for the U.S. CCPs that are significantly present in more than one jurisdiction, the FDIC co-chairs crisis management groups for 3 of those firms as well. We co-chair with the CFTC, a CMG for Chicago Mercantile Exchange, and ICE Clear Credit, and with the SEC for Options Clearing Corporation. You'll hear more about that work in the afternoon session. Member authorities generally reflect supervisory and resolution authorities of the largest members of the CCPs, other resolution authorities of systemic foreign CCPs and central banks, where products backed by their currencies of issue represent a significant open interest at the CCP. The objectives of the CCP CMGs are very similar to those of the GSIB CMGs. The key difference is that they were largely established a number of years later than those for the GSIBs, and so the work continues to really be in an evolutionary phase at this time. But the members of the 3 U.S. CCP CMGs represent 15 host authorities from 7 jurisdictions, in addition to those from the United States. So, needless to say, there's far too much to cover as a home authority to dive too far into our memberships as a host. But I just wanted to say that the FDIC participates in supervisory college and CMG and resolution colleges for numerous foreign GSIBs and CMGs and resolution colleges for foreign CCPs as well. We participate, for example, as a member of the UBS CMG, which you heard Stefan discuss earlier today. I'd like to just jump to the other anchor of our work in this area, which is to maintain ongoing working relationships with other authorities. So authority-specific, firm-specific, authority-specific. I would say that our work that's authority-specific is an equally important dimension of our work to communicate with other authorities about cross-border resolution. And that work really could be firm-specific, it could be policy-related, it could be operationally oriented, or it could be a mix of any of those activities. The FDIC maintains working relationships through a number of standing working groups. You may have seen some of our public statements about the work of the Trilateral Principles Exercise, which involves ongoing work of the authorities from the US, the European Union, and the UK to maintain a portfolio of work that evolves over time to build strategic elements to support cross-border cooperation for resolution amongst those key home and host jurisdictions. That work is reviewed and augmented by regular meetings at the principals level to give input to staff and to maintain crisis management preparedness at the senior-most levels of the 3 jurisdictions as a permanent part of our mindset. We also leverage a network of contacts built through our engagement in various regulatory fora. The US-EU Joint Financial Regulatory Forum and the US-UK Financial Regulatory Working Group are probably the 2 most prominent such dialogues. Then we engage with other authorities through the Financial Stability Board and our work of the Resolution Steering Group. Our chairman is the chair of the Resolution Steering Group and is currently in his 2nd term in that strategic leadership role. We have a standing membership, not only in the Resolution Steering Group of the FSB, but also in its sector-specific committees for banking, financial market infrastructures, including central counterparties, and the insurance sector. RESG leads the work of the FSB as the standard setter for resolution regimes for systemically important financial institutions and increasingly works on developing operational preparedness for resolution execution through practices papers, workshops, and enhanced engagement, including with the FSB's regional consultative groups. We use this forum to build and maintain working relationships with other authorities that are core to cross-border cooperation and resolution, to build a common understanding of resolution issues that cross borders, potential strategies for addressing them, and expanding our reach. Tim asked earlier, I believe, about consideration given to banks that could be systemic in failure that are not GSIBs, and I just wanted to mention that the Res G also in the banking sector increasingly is picking up that thread of work as on the heels of 2023 lessons learned. For example, we're now moving forward with work to build out practices paper on transfer tools on bridge banks and P&As to be able to share that knowledge with other jurisdictions, including those who are not necessarily FSB members. And we got a lot of appetite for that actually from those jurisdictions. But I think in some, our work in the resolution steering group allows us really to build the relationships to pick up the phone, call counterparts in an emergency, explain the issue at hand, and bring in the coalition of the willing to support a response, whatever the issue is at hand. In Silicon Valley's failure last year, Tim may recall that that really was a capability that we brought to the engagement. We worked quickly to work not only with the bridge bank, but also then with the foreign regulatory counterparts where the failed institution had a presence in order to bring them into the dialogue to figure out what the issues were and to try to make that connection with the bridge bank to support the transition from failure to bridge and then into exit. Sean Connie mentioned in his remarks earlier exposures that we work through on the heels of the sale of the SVB bridge bank and the parts of the institution that were not purchased by the acquirer. In that regard, I think Penn was going to mention maybe one aspect of our close work with the German BaFin in that case.
Yeah, I think this is a great example of the importance of cross-border coordination. As Betsy had indicated this morning, we had received an IDI resolution plan from Silicon Valley. We really hadn't had time to engage with the firm or cross-border, but we're aware of their international contacts. When we sold the bank in order to maximize value, we gave an option to the acquirer to whether or not to pick up the international aspects. It did not pick them up, so they were left in the receivership because of the plan. We were aware of them. One of them, Silicon Valley, had an office in Germany. It was a loan production office. And while we hadn't engaged, Joanne and her group, have a long-standing relationship with BaFin, the German banking authority. So we had that connection. So we immediately engaged with them, involving the FDIC, making clear to BaFin what the situation was with the office, what the receiver was planning to do, and how it would handle it. Given our work, BaFin, recognized the need for recognition of the resolution in Germany. Recognition is a process whereby the Foreign Resolution Authority enacts something that allows the resolution to become effective and enforceable under local law of the host jurisdiction. Recognition generally turns on the consistency between the regimes and the notion that what's being done in the resolution would not violate local public policy. So, given the work we've done with BaFin, we were able to move relatively quickly, and ultimately this led to a recognition order issued by BaFin that helps stakeholders understand the legitimacy under German law of the FDIC receiver's resolution of SVB, and allowed us to sell the branch assets in Germany in a way that maximized value. So, even though we weren't able to plan specifically about Silicon Valley Bank, the relationships that we'd established made this a fairly successful transaction.
And then I would just say that a key message that we had for foreign host authorities in that case was the priority that we gave to the orderliness of the handling of the situation as best we could under the circumstances. And I think that our ability to communicate and the ex ante relations that we had built with regulators involved really helped support that objective as best we could in a very rapidly changing situation. I would say then, just to conclude, that our work also reaches far beyond what I've just described for the FDIC at large. The agency is a significant leader in the International Association of Deposit Insurers. That work expands our reach to a number of jurisdictions and authorities beyond the core that I just described, and as well our engagement through the Basel Committee facilitates our continuing relationships that may need to be called upon in ways that we don't necessarily know at the time, during the planning phase, but may encounter at the time. So with that, I would like to hand it off to Ryan, I think, to walk you through our delivery of communications.
All right, so we've put out the paper. Susan walked you through it. Joanne's talked about some of the preparatory work that we do. With this session, we want to think about what happens when we actually have to apply this plan. How do we deliver communications at the time we resolve a GSIB? The pattern of the next few slides is who, how, and what. So we'll start with who we need to reach here on slide 25, and then we'll talk about the process for communicating to them. And then want to focus in on what we'll actually say, what the message is to these stakeholders in a GSIB resolution. While a single point of entry resolution hasn't yet been tried, the concept isn't that complicated. At least that's the intent, is to simplify the process. But given the size and scope of a GSIB's operations, communicating clearly and quickly to the full range of stakeholders pictured here is going to be a real challenge. These institutions, some of them have millions of customers, many thousands of employees, and operate in over 100 countries. So while we've represented the stakeholders here in 4 groups, each needs to be reached immediately upon entering the resolution and through a range of channels with some different focal points on messaging to these different groups here. And each of these groups is essential, so it might not be right to say that any one is more important than another. But what we'd really like to focus on today and get your reaction to is how to reach customers and counterparties of the institution. We know in a GSIB resolution, it's not going to be immaculate, that parties are going to be already pulling back, if not outright running, and instilling some confidence in the customers and counterparties of the institution will be key to stabilizing the bridge, to stabilizing markets, and to achieving an orderly outcome.
Could I ask?
Yes.
Why is it you don't list the board of directors of the institution? You talk about the executive management and its committees.
Yeah.
It sounds to me like the board's an awfully important group of folk.
Certainly. Now, as a function of placing the holding company into receivership,
you get rid
the board will dissolve. So part of what we have in our executive search pool is we would be placing not just a new CEO, but a new board. Now, maybe some of the board members, if they'd come in recently, maybe there's a reason to retain some of them. But certainly they have a lot of perspective that we want to.
Well, not only that, but they're going to be important communicators of what has happened. And I would simply make sure that they were communicating a message that reflected your priorities.
That's a great point. And maybe that's something for us to think about more, is how we can enlist them in this process. All right, so turning to slide 26, just a little bit on process here. How do we reach all of these parties? We'll need to be prepared and very active. And most critically, we'll just need to heavily leverage the personnel and capabilities of the institution that we're resolving. So on the left-hand side, we've done a lot on the peacetime planning here. Importantly, the Title I plans are all required to have a crisis communications plan that we would plug into. We learned in the 2023 bank failures that it was very important for us to have a capable crisis communications advisor to support us, to support bridge management. We've taken some of the lessons that we've learned from those events and really beefed up our Title II communications playbook with template materials and talking points and scripts that we would adapt, but are ready to be deployed. And then Joanne mentioned some of the work that we do on a cross-border basis, and some of that is exercising. And I just observed that the principal level exercises that she noted that are held every couple of years, we always have communications as a key component of that. We game out what we would do in terms of recapitalization liquidity, but it kind of all comes back to turning to the principals and asking them, what would you say as a principal upon entry into a GSIB resolution, and how would you support stabilizing the wider financial system in doing so? I'd like to come back to outreach. We've done outreach with some parties in advance. We are doing more. We could do more. And it would be good to hear from this group where more attention might be needed. In the middle of the slide, in the runway, we'd be taking all of this planning work that we're doing, tailoring it to the scenario encountered, and then starting to engage with the institution itself, with our advisors, with other authorities. Joanne talked about the crisis management groups. Those would be very active in the runway, and a portion of that would be planning for communications that we would deploy upon entry. And then upon entry, again, a lot has to happen simultaneously. And we know that GSIB resolution is going to require principals from authorities to be very direct and visible in their messaging, and that we'll need to have a lot of information that we publish immediately, Friday night, that's available for people to turn to. Press releases, press conferences, also a financial institution letter that explains what this new an entity that's going to sound exotic, a bridge financial company, what it is and what it means, and how other parties can continue to engage with it. And then some basic financial information, at the very least, some basic financial information, key metrics about the institution, ideally a basic balance sheet that just shows that the group and its subsidiaries have been recapitalized, or that there's more than sufficient TLAC to do so. And we'll need to push all this messaging to and through the institution, starting with messaging to staff. What does this mean for them? Why should they stay on and support the resolution? We'll need to provide key messages for all the personnel who are engaging with customers and counterparties, do's and don'ts, talking points. We'd expect a series of distributions and calls to different key client groups that are tailored to them, again, in coordination with the institution. All of this coordinated with FDIC communications office, our advisor, the communications team at the firm, to make sure that the messaging is going through all channels, press release, proactive and reactive, social media engagement, websites, call centers, all of that is consistent. So that's the how, and let's turn to slide 27 and talk about what we would actually say. And we'll start here at
just make the point
yes,
that you have other actors in the government, like the Fed and Treasury and so on, and you need to coordinate what they're saying as well. It's actually not that easy.
Why do you say that?
Some nightmare of mine.
Well, and I mean, to that, actually, I think we'll talk about this a little bit on this next slide. But the Treasury and the Federal Reserve and the SEC and others are engaged in these exercises that we have around GSIB resolution, members of the crisis management group. And there's probably some natural roles that fall out when we've thought about what the communication is at the time. So I'll actually get to that here. Maybe starting at the top, the goal of all this is to promote stabilization. We know we're starting from a point where there's uncertainty among staff, and there's probably wider effects to the financial system. There's probably similarly situated institutions, even as we saw last year with Credit Suisse, where that there was some inference of concern about other institutions, and all of that we'll need to address. So starting at the top, at the principal level, some things that U.S. authorities are going to need to say. And expect all the key turning authorities, Treasury, the Federal Reserve, the FDIC, to be involved here. It's just how the institution got to this point, what the cause of failure was, and why Title II is the appropriate authority to address it. And then what the condition of the broader financial system is, and if necessary, anything that's being done to address the wider financial system. And even if it's not necessary to deploy additional tools, just observing that additional tools are available can be very helpful. So that would be something that those first points are probably more for U.S. Treasury and the Federal Reserve than they are for the FDIC. The FDIC would need to speak to the resolution process. And the second sort of bucket of bullets here, some of the things specifically that we would need to address. One is accountability, that the senior-most officers have been removed and that shareholders and creditors are going to bear the cost of the resolution, not customers and counterparties at the subsidiaries. We really want to focus our messaging at this time on stabilization more than accountability, but addressing accountability up front, we think, is an important complement to being able to deliver very strong messaging on the stabilizing actions that we would take. Of course, replacing at least the senior-most management, we think is important to instilling confidence in the resolution process, as it was with the bridge banks last year, that there's new management in place that is credible and can run the bridge through the resolution process. I take your point earlier, Tim, that we want to retain as much of the talent as we can. I think that's our bias. And the focus on this time is really on stabilization, but it's just not credible to run the process with the same CEO that was there when the firm failed.
I want to pick up on John's point because you might want to add to this. You're going to have a new board, which, and I think the general thought has been the new board would be, to use a British phrase, the great and the good. So that those would be people who could be out there in the market and who would be credible. And then, I think what we saw in the bridge banks and what's expected is the CEO, the CFO, and probably the CRO all just automatically have to go. But I guess my question is, let's suppose the problem is a rogue trader, or the problem is in the credit card operations. And then you've got the member of the executive management team who is doing commercial real estate, which wasn't part of the problem. I'm kind of assuming you'll be making, it's not going to be immaculate, but you'll be making judgments about keeping who you can keep to keep the institution running, well, knowing kind of who was in the center of where the problem was.
I think that's right. Part of this will come down to the new management that we bring in. We bring in a new CEO. Who do they feel it's important to retain? And there's going to be some judgments to make about who needs to stay. But I don't actually know that's necessarily the case that all of the positions you mentioned will necessarily need to go. I think it depends on the situation. And even if some of those individuals aren't retained, I think that they clearly will have a lot of very valuable information about the institution, and the new management that we bring in will want to speak to them to gain their knowledge.
And the new CEO needs to have a team. And the statute, as I recall, gives you an enormous amount of flexibility here.
I see both hands up and smiles on the screen. So questions.
Yeah, just a couple of observations from Jay Clayton on this. And good points. The board of the great and the good that would come in as replacements.
You're hard to hear.
Stable.
Jay, you're a little hard to hear if you can speak up.
I'm trying here. The board of the great and the good, I think you need people ahead of time who are, fully vetted and ready to go. Is there the vetting takes too long, to do it in real time. And then the other thing is, I don't think that there should be a big reliance on former board members. That they're really not going to be. My experience is they're not going to be available to you. You're going to get better continuity from the accountants and the people in those places who are going to have to stay than you will from former board members.
So maybe really quick on board members ahead of time. So as part of our executive search program, we're also identifying board members that we would bring in. And so we would need to bring in at least 5 board members. Even for the bridge banks last year, we were identifying board members. It just happened so quickly, and the bridges were of such a short duration that we didn't in place a private sector board. But had Silicon Valley Bank gone on for any longer, one of our next steps was to put in place a private sector board that we had already identified a set of individuals that we think could have been suitable. So I think that's really important, and that's part of our planning in advance. Judge Drain wants to come in on this.
I want to emphasize that when you're communicating, particularly to the public, but also to the customers, the parties that deal with the bank, not depositors, but the customers and the subsidiaries, focusing on who's coming in at the management level to solve this problem, to my mind, is key. The regulators are clearly doing their job, and that's an important message. But when you send the message to the markets, you're going to be focusing on people like Tim Myopoulos. It's very hard for a congressperson to criticize Tim Myopoulos. It's very easy for them to criticize a regulator. It's less hard, put it that way. And that human focus is key to retaining confidence.
Taking on the brunt of congressional criticism isn't our only goal, but I know Gary Cohn wants to come in.
Yeah, so let me make 2 points, I think. First one is, I think your assumption is you can always get to Friday night. I would take that assumption out, because the bigger the bank gets, the harder it is to get to Friday night. So our history says you've been able to punt these things to Friday night. If this thing happens on a Tuesday, I think it's a lot different than if it happens on Friday and you get Saturday, Sunday. So that would be the first point I would make. Second point I would make is, if it's a Tuesday or Wednesday or a Thursday, when you make the announcement, that's the relief moment. Like, once you've taken over and you put it into Title II, that's the thank you moment. The real problem is everything leading up to that. And so far, everything leading up to that has been Saturday and Sunday, and markets, for the most part, have been closed. So I think you have, in many respects, you have to recalibrate a live market scenario where this is going on. Because I think if you don't have that assumption, you're going to wake up one of these times and it's going to be a different set of scenarios.
Maybe if I could just come in to amplify one thing I've been thinking about through this presentation is the risk of leaks, the risk that you get wrong-footed, and the preparations and the team building you need to do, working across multiple regulators, for example, being able to respond in real time. To date, we've been lucky. I think, for example, in the Credit Suisse case, given the outreach that had to be done internationally, I was shocked there was not an earlier leak that something like that was going on. But I think some preparations around that for a possible Tuesday disclosure of something awkward would be very important to have in the toolkit.
Yeah, one of the advantages of SVB is there was no risk of leaks because it just failed overnight. So to deal with.
There was no time to leak.
But it's a constant concern, and I think authorities are always calibrating how wide is the circle of trust in terms of who we're bringing in and planning. But it's a challenge to get that balance right. I think one of the things that we try to do to mitigate against that is just have our philosophy is to have an appetite for false positives. So we're doing planning even when institutions are healthy or there's a relatively minor risk, and maybe that mitigates a little bit against the fact that we're planning is a concern, but it's a challenge for sure. Yeah.
Ryan, another question on communications. This sounds like a very well thought through package, but I think another critical communication on that first day will be what the 7 other GSIBs say about themselves and say about the bank, which is now being resolved. And I don't know how much planning, maybe it's implicit in what is here, as thinking has been done and planning about that.
That's a great point. And, one of the places that I think we wanted some input on was where we should do more outreach. And I think with the GSIBs on how a resolution of another entity would affect them and what they'd want to hear from us. We'd be working across the authorities, I think, on coordinating that engagement with, the Federal Reserve and OCC and others who have a big supervisory presence.
I just wanted to, like the Jim, just wanted to come back to underscore a point that Judge Drain made. I think in retrospect, from the bank failures last year, but there was no more important decision that we made than in the selection of the CEOs to take over the failed institutions. And we had two highly credible CEOs, both Tim and Greg Cochran, the former CEO of Fifth Third. And I'll tell you, it didn't come to this with First Republic, but we had another individual of comparable credibility available to take that over. And I do think one of the big improvements we made was prior to those failures last year, putting in place a pretty highly developed process for identifying individuals who would be prepared and credible to serve this role. It's not a huge universe of people, but we were able to identify quite a few, and having them available on short notice to do that is, as I think was also pointed out, their communication, their role in the communication is as important as, or more important than what we might say. So, and the simple stature of that individual, I think, makes a big difference in terms of the perception of the resolution process.
I'm curious how you're thinking about the time horizon giving rise to a failure. SVB failed literally overnight, right? But going back to something Gary was saying earlier, like the market is going to be telling you that one of these institutions, one or more GSIBs, is approaching failure. And so it's almost as if you need to get ahead of it much earlier than you would in the case of, let's say, an SVB or a Signature. And I'm curious as to whether you agree with that, because obviously nobody actually wants to put a GSIB in a resolution. But it does seem to me that the market's going to be sending lots of signals to you about a potential failure, and you're going to need to be able to like accelerate all of this process that much faster.
Yeah. Agree with that. You know, one of the charts that we have in the paper shows that we expect to be doing Title II planning at the same time the institution's initiating its recovery plan, at the same time it's planning for its bankruptcy plan. So we'll need to have an appetite for a false positive. The thing that's going to be difficult is you don't know when or if it's actually going to fail, and we have to have an appetite to start preparing before it does. With the GSIBs, one helpful feature is that they all, in their Title I plans, have lots of triggers and governance mechanisms for pushing them through the resolution process. So that's one thing that we have that we don't have for smaller institutions that we can key off of. You know, it's going to vary. Credit Suisse, you could see that there was stress for a long period of time. You couldn't hope for a longer runway than we had. We had the fall, we had the spring. That was a pretty good amount of time to plan. SVB is the exact opposite. And, you know, the events from last year has got everybody focused on the fact that we don't control the timeline. We need to plan for more truncated timelines. We need to be prepared to initiate our planning earlier when we see that there's some indication of stress. But we don't know what the timeline will be.
Just maybe two other groups to think about in terms of communications, rating agencies and external auditors. Because I know in prior instances, they can be wild cards in terms of the information environment. The other is, you know, the host authorities, I think, are quite critical because a lot of folks are going to be looking to them. You know, I just think through the counterfactual, if option one had gone for Credit Suisse, how much communication we would have had to done in the U.S. In coordination with, you know, FINMA and the home authorities, because silence will be interpreted badly, and yet pressure to that communication is going to be very, very tricky for any host authorities. And I think for those of us who have been through 2008 and other crises, there's a certain kind of muscle memory from some of these. As we move further and there's kind of newer entrants into positions in these agencies, I think that may present certain challenges. I look around the table, like we have had these discussions. I can think of specific instances, whereas I think as we get further and further away from some of these international instances, it may be a bit trickier to do.
So maybe I'll continue by taking up that point. Some of the other points that are here about financial information and what the plan is for restructuring, we've touched on a little bit, and I'll actually come back to on the next slide. On host authorities, I think, Joanne talked about all of this coordination work that we do in advance on an ongoing basis. And we've talked about how we would activate a crisis management group. All of that activity, I think, really has one key goal, which is to put the host authorities in a position upon entry into resolution to say that they've been coordinating with, and I think, like as you say, not silence, they need to have joint announcements with us that they've been coordinating with U.S. authorities, that the operations in their jurisdiction can continue to operate without disruption, that there won't be separate resolutions, and that the single point of entry strategy is in the best interest of their local stakeholders. And so we need to put them in a position by demonstrating there's adequate resources and that we have a plan to be able to say that. And then, of course, new bridge management will need to be visible at this time as well. Their first task is to speak to the staff of the institution, ideally at that time to speak to retention agreements and the general plan going forward. It'll be important that the new CEO is also messaging to customers and counterparties that the bridge is able to conduct business and meet its obligations. And like the FDIC, the new bridge management will need to speak to the path through resolution, at least in a general way, and provide some sort of business narrative, what the goals of the resolution process are and what the results might be.
Can I just take you back to the U.S. authorities?
Yes.
And the stabilizing actions. So the hardest thing is how you stop the run, basically. There, you hope the insureds are convinced, but you worry about the uninsureds. And this comes back in the US to the systemic risk exception. But yet we've all got this issue. It struck me, first of all, that stabilizing actions should be a joint US authority message, not an FDIC message. Because you're really speaking for the central bank and the public sector backstop, going back to what we talked about before, and it has to be very convincing in that initial, if you're dealing with a GSIB in that initial period, and that'll matter internationally as well. And I think it's buried in conversion of TLAC. Obviously, that's for the FDIC. But use of the OLF and the liquidity issue, yeah. I would kind of, you have to decide very early on whether you're guaranteeing all depositors or whether you're not. And the worst thing is when you say you're not, and then it turns out that you are. But that's how the thing, and that clear message out front is hugely important. And getting to that point is hugely difficult, because it does involve coordination. So I'd kind of put that front and center in the message from the other authorities. Because if you get that communication wrong, then the whole thing will just become much more difficult. And you'll probably wind up doing it anyway, but it will look as if the resolution is failing.
It's very helpful. And I think, we'll take some of that into account, or all of it into account, but I think some of it's addressed a little bit on the next slide too. So just to keep pushing forward. All right, so all of that was intended to be backdrop on the broad messaging, and then we want to drill down into customers and counterparties. While FMUs and trading counterparties are kind of last on the page here, we actually think that those might be some of the most challenging, and so would be particularly interested in your views there. But let me quickly address investors. These are the people who are, as we've mentioned repeatedly, are bearing the cost of the resolution. That said, when we've talked to TLAC debt investors, we've consistently heard that they'll be looking for whatever reliable financial information is available so that they can price their claim. And we think being able to provide some information at the time of entry is in the interest of markets, and that we would seek to do what we could. Also, these are creditors that are accustomed to having a more significant role in a bankruptcy context and a restructuring. And this is going to be different. This is an administrative process, but we're considering ways to allow for an appropriate level of engagement through the resolution process, as these will ultimately potentially be the owners of what comes out of the resolution process. Traditional banking customers are, of course, tremendously important and represent just a huge number of people, certainly so at the universal banks. And here, and able to reach this vast number of individuals. Again, all the published material that I talked about earlier, pushing that through the institution and using the institution's capabilities is really the only way to do it. And then, specific messaging on, on the point about depositors, I think we'll need to be clear that in a single point of entry resolution, the insured depository institution isn't going into a separate resolution, and depositors' money is safe. All of depositors' money is safe in a single point of entry resolution. And then it'll also be important to be clear that there's no confusion that, the bank is still open and operating, and all of the activity that it could conduct before it went into resolution, it can continue to conduct out of those subsidiaries during the resolution process. And yes.
Just a comment about retail customers. As sad though it is to admit, I think it's essential that the FDIC have a specialist in internet communications, watching X or Twitter and Reddit and a whole variety of places where these rumors get amplified and started. There really needs to be some thought given to, unfortunately, the way retail customers primarily receive information these days.
Absolutely. And in preparing for this, our director of communications, Amy Thompson, actually flagged for me that the social media engagement isn't just proactive, but we've got some experience for different types of events, combating rumors and misinformation, and getting outside support to do some of that. So I think that's a point well made.
On that point, have you thought about who are other influential people who can help guide consumers? Yeah. We live in a world where, for better or for worse, many people don't trust the government. Like they don't trust traditional institutions, but they do trust other people, like these so-called influencers that I don't really consume, but other people do. And so it just seems like that's potentially a valuable thing to think about as something to draw on.
Sure, that's really helpful. All right. Corporate banking customers, you expect there to be direct outreach with key clients starting over resolution weekend. So then turning to FMUs. So FMUs are a special case, and the goal here is to maintain membership, reduce financial stress on the institution. There's a discrete set of key financial market utilities that each GSIB's been required to identify as part of its Title I planning process, and they've been required to develop FMU playbooks to enable continuity of access in the context of resolution that take into account each FMU's unique rulebook. Those would be activated. We'd be plugging into them. When we've done outreach with financial market utilities on Title II in the past, we've heard consistently, and I think the GSIBs have heard this when they've done their own outreach, that they're going to want to hear from the same points of contact that they have at the institution that manages the relationship with the FMU immediately over resolution weekend. And in Title II, we've been told they're going to want to hear directly from the FDIC as well. And then, kind of bottom line is that they've also told us that the institution's going to need to demonstrate its ability to meet any additional margin and pre-funding requirements Monday morning. The availability of the OLF will help demonstrate that we're able to do that, but that's sort of what it all comes down to. And then, in talking some of the discussion about coordinating with other authorities, coordinating with FMU supervisors in the run-up to resolution will be important so that there's complementary messaging from them when we go into resolution 2.
So another group you might think of, Ryan, is what I'll call dominant third-party vendors, because we focused a lot over the years on FMUs, but perhaps say payment processors, the major tech companies. GSIBs are going to be less reliant on core processors, but they do have third-party tech and kind of core processors. And I think the experience of 2023 is that some of those dominant vendors needed special attention.
Could I just weigh in on this a second too? Because I think this is important, and I'm thinking about it from a standpoint of a GSIB going down and the knock-on effect or domino effect to the FMUs. Now, as you said, the different types of FMUs, but the FMU by its nature is going to want to protect the industry it serves. They are going to move very quickly. the machine will turn on faster than you could imagine, which means communication and clarity is paramount because they're going to protect their flank, and they should. So they will move more quickly than you think. So I'd put a finer point on this idea of having a clear, crisp comms plan to the FMU so they can make the most informed decisions. Because I think we said it earlier, the market is going to move and the FMUs will have to react to that as well. So I just would sort of circle that one as something that probably needs more of a conversation.
Noted, yeah.
This may not be true in the new regime, but in historically or in practice, most common resolution method is acquisition in whole by another firm. And at what point in a more formal structure is there search for a potential acquirer or partner, and how do you manage that information flow?
So, I mean, part of the premise of single point of entry for the GSIBs is that the traditional approach just isn't available because you're unlikely to be able to find a suitor, and you certainly can't rely on that. Now, again, single point of entry allows for optionality within it, and it might be that there's parts of the institution that wind down, there's parts that get sold to other parties, or there's a core that gets sold at the end of the process. Now, it allows for it to be spun back off, but finding an acquirer for parts or for a large portion is a possible outcome. I think that's probably, we're not planning for that to be a day one solution for these institutions, but it's possible that that could unfold during the resolution process.
Have you looked at the possibility that the reason for the failure is a massive data processing collapse, so that you're dealing with an institution where you don't have much of an idea what's going on and the customers don't know if their money's there or not?
Yeah, it's a great and terrifying question. The FDIC and in coordination with other authorities has done a lot of work on cyber incident response, different types of cyber incidents, including those that might affect large institutions and lead to their failure, and looked at the range of tools. Now, the tools that we're talking about today are financial restructuring tools. They're not tools that can directly address a cyber incident. And so, we've looked at what are the possible scenarios we could be dealing with, what are the most likely types of cyber events or other operational events that could disrupt an institution. And if that happens within a single point of entry resolution, how are we addressing that? But it creates a lot of other complications, and it's a whole other topic that maybe we should come back to in SRAC at some point.
I think one thing that we're gonna have to think through is there's in certain crises, there's certain price signals that everyone tends to focus on. I think this kind of ties together maybe Tim's point and Frank's point. In 08, it was CDS spreads, right? Everyone focused on the 5-year CDS spread. That kind of drove a lot of the behaviors. Last year, it was just share price. Here, once you take a firm into SP08, there is no share price and there is no CDS spread. And then the question is like, what signal do counterparties look to provide that confidence to say it's okay to trade with such and such entity? And then you've got the compound problem contagion-wise is that for peer GSIBs, their CDS spreads are going to blow out, their share prices will take a hit, but then is there a different signal that can provide the confidence to say, well, if they were to go into SPOA, their op subs are also going to be, I think we haven't quite figured out what that key signal that everyone will look to that is credible, that will be seen as not something that we are promoting, but that market participants can then utilize. I don't know if this is kind of new ground. I'm not sure we've kind of quite gotten there yet.
That's a really interesting point. And the TLAC bonds will still be trading off market, so maybe that's one place that you could turn to, but it's an interesting point.
So let me, because I think it is a great point, ask, would it be feasible, and this goes back to the rating agency point as well, to do new issuances quickly into the debt market so you have somebody showing real confidence in the bank, and whether that's other banks, private credit, combination, somebody else? That's how I think you might restore it. Just one other quick point, if I could. On the rating agency, which I agree 100% with, this has got to be more than just the big three, because the deposit rating agencies will also be a queue. If the deposit ratings are downgraded, that's a real problem.
Very helpful. So maybe just to finish off with trading counterparties, these will be also a challenge and critically important, especially as most of the institutions with large trading operations have a solvent wind down of their broker dealers as part of their resolution plans. A considerable amount of attention has been given to those solvent wind down plans in the Title I process. They are very detailed in terms of projecting the resource needs that are required to carry out the plan. They have detailed segmentation of the portfolios and breakdown of how those would run off over time. So those would be very helpful to turn to. Here again, kind of the bottom line is being able to demonstrate that there's more than adequate capital and liquidity to keep the entities open to carry out a solvent wind down. And then there's some other points that I think are important to emphasize. So I mentioned the financial institution letter that we would put out. Some points that'll be really important here to trading counterparties are just re-emphasizing these are the same legal entities that you had your positions with before they failed, the same contracts. That's different than the bridge banks last year, where there are a lot of operational questions because you had a new legal entity here. That won't be the case, and in some sense, that'll simplify things. And then we'll need to remind everybody that there are statutory and contractual stays from immediately terminating financial contract positions just based on the event of resolution. There's a Title II stay. There's been revisions to contracts through the ISDA resolution stay protocol, and reminding everybody that those are applicable would be something we need to do at the time.
Brian, your mention of winding down a solvent entity reminds me way back when they were trying to wind down the securities subsidiary of Drexel Burnham Lambert. And it was quite visibly very solvent. But it was necessary, I think, in the end for both the Bank of England and the Fed to guarantee during the clearing process that the other creditors wouldn't seize the proceeds. Are we beyond having to worry about that sort of thing, or is that another piece of the puzzle that needs to be addressed?
I'm seeing others say no. I was going to say, like, at least the termination of contracts, though, if there's performance on the contracts, there's not going to be a right to terminate.
No, it's during the clearing process.
Oh, I see. Yeah, so there might need to be either make sure there's enough resources that there's confidence that there doesn't need to be some sort of additional assurance, or if it's necessary to provide that, then we'd look at the right way to.
As I understood it, it was creditors that saw this as an opportunity to improve their position because it was an asset they could seize. But I'm sure others know a lot more about this than I do.
I mean, I haven't studied that case in particular and should, but one thing I was going to say is while this this solvent wind down approach is a big challenge and seems daunting in some ways. There's been a lot of planning done in Title I. We're also in a far better position to wind down the trading operations of a GSIB than we were with AIG Financial Products and the 2008 crisis. And while a single point of entry resolution was undertaken for Credit Suisse last year, all the authorities were prepared to coordinate around that, and it would have involved a significant wind down of the US and UK trading operations. And I think even the supervisors of those entities were pretty confident it could be carried out. So that's everything we had here. We're a few minutes over, and I think we've gotten to the questions. So if there that we had on the slide,
if there are any other, we have a few minutes here. If there are any other questions, Ted.
Yeah, I have a question. I'll try and get it clear. I waited till the end, so hopefully I can remember all my thoughts. But there's a couple. One of your questions is, what can you do in advance to promote confidence in the SBOE process? So if I understood correctly at the beginning of this conversation, and I think I should have already known this and probably did, early in the process, the FDIC has to make a decision and claim publicly, I guess, that Title I cannot be executed, right? So you're not confident that you can execute Title I.
Well, that's one of the requirements for using Title II. We have to assess that.
So you've got that. Under Title II, to quote your slide, it's more feasible that you could actually have a successful SBOE if there's sufficient capital and resources in place. So I'm wondering if we can put these two together somehow. One of the concerns I've always had about this is the consequences of, to use the wrong word, failing the assessment of your resolution plan are so intense that it's very unlikely that they will be used to their full extent very often. But one way to think about this, if I suspect you know right now whether a firm can be resolved under Title I, or you have a pretty good idea. And if you have very clear signals from the firm that their capacity to prepare for a Title I bankruptcy resolution is impaired, maybe what you need to do then is to make SPOE more likely to work, is to actually require that there be sufficient capital and liquidity pre-positioned in all of the major subsidiaries, required by rule, right? As opposed to some guidance that this is how you should measure it. So I'm just putting it out there that the consequences, we all know. I worked in your business for a long time. I know how hard this stuff can be to do. I think you need to find some lever to get the institutions and those on the board of directors and elsewhere to really take seriously their responsibilities with respect to preparing for a Title I resolution that are short of the nuclear option that exists today and is unlikely to be used. So I'm just throwing out a possibility. If you know in your mind you're likely to say we have to do this because it can't be done in Title I, that seems like a reasonable time to increase the requirements for some of these banks in terms of capital and liquidity and pre-positioning. So, and I please just
well, that how prescriptive to be on resolution resources is a policy debate that continues. We have, through the resolution planning process, required that institutions demonstrate that they have a credible amount of capital and liquidity pre-positioned to carry out their strategy, but it's not obvious that it's going to work in all cases. There's going to be scenarios where that breaks down. And we think that the key differentiator here is going to be between bankruptcy and Title II is going to be liquidity. They're required to maintain a lot of liquidity to carry out their resolution plans. But if we're assessing on a given scenario that that's insufficient, Title II does bring a lot of additional liquidity to the table. And so I don't think it's necessarily either or. I think it might depend on the scenario to a degree.
Fair point. I guess my point again is that the banks are supposed to be responsible for ensuring they have a credible and effective, actionable Title I plan. Yeah. If they don't, which means you have to make the decision to go to Title II, that's because they failed to do what they were required to do.
I think that would be the judgment.
That's the point I'm trying to get at, right? Yeah. And so what can you do to then provide appropriate leverage to get them to not fail in the first place in that regard? That's mine.
As a resolution practitioner, very much in favor of. I see Gary Cohn has his hand up.
Yeah, look, I think on the trading book side, you should go back and look at 2008 for the, I'll say Goldman Sachs and Morgan Stanley. How's that? I'll pick on the banks without deposits at the time since I was at one. When someone knows that you're no longer in the trading business and someone's actively forced to actively wind down a trading book, which was the assumption in 08, all of the winning positions leave your bank overnight. And the bank is left with losing positions and margin. And anyone who's got positive collateral, positive positions in a bank, this is worse than a run on deposits. So the fact that people will know that the trading business will cease to exist, the prudent thing for any counterparty to do is move their position out prior to or as quickly as they can. And we saw the living example of this in 08. So, I mean, just put that into your calculation.
So back to the point on Title I plan credibility, that's in that the institutions have solvent wind down plans, and that's part of what they need to calculate, what we need to assess. Are they making credible assumptions about how that will occur? But this is about, do you have an overabundance of capital and liquidity to allow those positions to run off and wind down? But agree, there's a reason we circled this on the page. We think it's the most challenging aspect here.
Yeah, I mean, look, I just go back to 08. You can see it in living color.
Yeah.
Can I ask, at the risk of beating this to death, I apologize, but this is important, right? So just focus on equity trading for a second, right? you've got some major G-SIBs who are trading with non-exchange firms. So my question is ultimately going to be, what's the communication plan specifically with exchanges? Because you can see those non-exchange trading firms will pull away from a G-SIB if they get a whiff that there's a problem. That order flow is going to go somewhere else, and it's going to have to go to an exchange. How much could they handle, and how much will they be able to step up in a stressed environment? So I guess my point is when you're thinking about trading counterparties, I would keep exchanges because they're committed to take on more of that flow that otherwise wouldn't go to them. And some of these G-SIBs, to Gary's point, they're moving tremendous amount of flow.
That's a great point. So I have equity exchanges, more focus on FMUs, rating agencies, external audit firms, third-party influencers. We've got a long list of people to do more outreach with, so that adds to it.
We'll circulate a list after the meeting. Any other questions?
Dominant vendors, that as well, yes. Yeah.
Let me thank the staff. Let's take a break for lunch and we'll come back afterward. Good.
Technically not, it's an academic thing. I'm technically at Brookings and not.
But no, I'm sure.
Yeah.
But I don't.
Yeah.
How to get in the book.
It's Brookings EDU.
Yeah. CC.
Is this on? Yeah. I hope everyone enjoyed lunch. And the last item on our agenda today is a discussion of CCP resolution. I think we have quite a few things to talk about. So let me turn it over to Art Merton.
Great, thank you. Yeah, we're going to talk about CCP resolution and the work that we've been doing there. I think earlier the chairman noted that we're in a different place with CCP resolution than we are with GSIB resolution. I think we like to think we've made some progress on GSIB resolution. And I think it's fair to say that we're not in the same place with CCPs. And you'll hear more about why, but I might make three observations or distinctions. The first is the statutory framework. Dodd-Frank made financial companies eligible for our Title II orderly liquidation authority. And for the US G-SIBs, they're also subject to our Title I authorities, including the resolution planning process, which has been, as you heard on the previous panel, a really important part of getting ready for the use of Title II if we had to. And I think as Tim Clark pointed out, Title I comes with some sanctions that are pretty meaningful if it's not judged that the firms have been able to make the changes necessary to become resolvable. The second is just our institutional knowledge of banks versus CCPs. As an organization, we've been involved in banks for 90 years, and we have a deeper understanding of them than we do CCPs, which is not to say we don't have people on here who are knowledgeable of CCPs and so forth, but it's just not the same. And then third and related is that in terms of our federal regulatory partners, again, we have a different relationship with the OCC and the Federal Reserve, a long-standing history of working together on both supervisory matters and resolution matters. And that's just a different relationship that we have with the SEC and CFTC. And we don't have that long history of collaboration on these issues. So those are just some of the differences that help in part explain why we are where we are. And with that, I'll turn it over to Aaron Wishart. But first, let me introduce the panel. Jenny Trailey, Senior Deputy in the Complex Institutions, Aaron Wishart, Laura Porphyris, and then once again, Penn Stark from our legal division.
Thanks, Art. That's a really helpful preview for this afternoon's discussion. As he mentioned, we're going to be kind of digging into some of the differences between the way we approach GSIB and CCP resolution here at the FDIC. And we're also going to spend some time talking about a new international standard that calls for resolution authorities to have access to a set of resolution-specific tools to aid in a CCP resolution. But before we talk about the differences, I think maybe it's just it's worthwhile to mention some of the similarities and how we would aim to resolve a GSIB and a CCP. For example, and we've talked about this a number of times today, the FDIC would manage the resolution of a GSIB using authorities granted to under Title II of the Dodd-Frank Act. We would use those same authorities for a CCP resolution. Title II lays out a process for determining entry into resolution, authority to access the Orderly Liquidation Fund, the OLF, and the hierarchy of creditors in resolution. These would all apply to CCPs just as they do for GSIBs. We would also expect to establish a bridge financial company to help manage the resolution of a CCP in resolution, and would employ some of the same stabilization tools for CCPs as we would for GSIBs. So overall, the way we would approach the executing a resolution in terms of mechanics and available authorities is quite similar for both. However, I think it's worth just mentioning explicitly here at the top that while we use some of the same concepts and approaches for both CCP and bank resolution planning, we do understand that banks are not CCPs and CCPs are not banks. And we do seek to take into account the differences in the two in our resolution planning. CCPs each dominate the markets that they serve without many readily available substitutes. They rely on clearing members relationships, and they operate on a very different regulatory framework, as Art kind of alluded to there. So those are some of the main differences we seek to take into account. I'll just focus on a few here kind of as we get started. The first is that because CCPs provide critical services to the markets that they serve, and as I said, there are not really readily available substitutes for those services. The primary objective for the FDIC in a CCP resolution is the continuity of critical functions that the CCP provides to market. So that, in other words, we don't see the short-term wind down of a CCP services, meaning a cessation of its clearing services, as a viable option in resolution, whereas that may be an option for a certain of GSIB services. The business model of CCPs and the regulatory framework in which they operate also present particular challenges. For example, by rule, CCPs must balance their books and adjust to market movements rapidly, so problems could come to light with very little notice. CCPs require members to provide funds daily and sometimes intraday, and members in distress or operational challenges could manifest with little or practically no notice. And while CCPs have adopted comprehensive resilience and recovery tools, they've largely not reserved resources for resolution, and we cannot rely on the recovery resources to remain at the CCP by the time we enter that would support an orderly resolution. We'll talk a little bit more on resources in kind of the next section of our discussion, but it's worth just noting here. Next slide, please. So the Title II paper, which Susan presented very well on in the earlier session, lays out the differences, the different phases of resolution along the crisis continuum, as we call it, from BAU planning through resolution execution and all the way to exit. We refer to these same phases in our CCP resolution planning, but we expect the events to move much more quickly, just as a rule. We've developed a visual, which you see on the slide here, to help illustrate the compressed timeline we expect to be up against in the case of a failing CCP. On the GSIB side, our planning generally considers that one of them would fail with some runway period where we could increasingly heighten our readiness posture. We just don't think we'll have this luxury for a failing CCP. An event that leads to the need to resolve a CCP is likely to occur during a period of market volatility or even really crisis or as a result of an unforeseen operational failure. A CCP could come under stress from member defaults, which we refer to as default losses, from losses from other sources such as a cyber theft or litigation, which we refer to as non-default losses, or from a combination of both at the same time. Because CCPs must maintain a flat book and meet payment obligations in specified tight timeframes, a default loss that burns through CCP recovery resources, which unlikely could, the CCP recovery resources, which are largely made up of clearing members' mutualized fund, is an unlikely event, but could crystallize very quickly. On the non-default loss side, CCPs largely do not maintain significant resources relative to the size of their daily payment obligations to address these types of losses. They're also typically unable to use members' mutualized resources to address these losses. So the default loss waterfall that you think about when you think of a CCP is generally not available in a non-default loss scenario. For these reasons, a significant but not enormous non-default loss could quickly outstrip a CCP's ability to make all required payments and thus may make resolution likely or necessary. This particular challenge highlights the criticality of advanced planning and preparation for a CCP resolution. We simply don't think we'll have the time to ramp up in the runway for a CCP resolution. Our Title II paper also includes an illustration similar to this. It has a slightly less precipitous decline. We colloquially refer to that as our ski slope illustration. I like to call this one our bungee jump. Next slide. So there are some further important differences in the resolution framework between GSIBs and CCPs that are worth spending some time on here. First, and we've talked about Title I a lot this morning, so I think that's an important point to start with to highlight differences. The Dodd-Frank Act requires GSIBs, as we've discussed, to file resolution plans with the FDIC and the Federal Reserve, which require them to account for their rapid and orderly resolution in bankruptcy. As mentioned, we learned a huge amount about the firms in these plans, including information on risks from affiliates and subsidiaries, ownership structures, assets, liabilities, contractual obligations, counterparties, and collateral information. CCPs, on the other hand, are not required to file such resolution plans. It's worth noting that the CFTC and the SEC, who are the primary regulators of the U.S. CCPs, do require them to develop recovery and wind down plans, and we do rely heavily on these plans in our resolution planning, but they just don't contain the same level of detail about a CCP's operational risks or operations and risks that are required in the GSIB Title I plans. And it's also worth mentioning here too that both agencies are in the process of enhancing the requirements for those recovery and wind down plans, and the proposals for both included a provision that would require the CCPs to consider the impact of financial stability for the application of their plans, which is a meaningful step forward. And as I've said, these plans are critical to our firm-specific planning and BAU preparation. So the FDIC welcomes these enhancements. But the differences, as I've said, between recovery and wind down plans on one hand and GSIB Title I plans on the other in terms of coverage and meaning in detail are meaningful. Another important point is that Title I gives the Fed and the FDIC the authority to address barriers to resolvability, which again have been discussed this morning. Any barriers that I identify through plan review. For example, through the Title I process, GSIBs have rationalized legal entities, developed capabilities to deploy capital and liquidity in resolution, and developed governance arrangements, among other things. Again, this is not the case for CCPs. Because CCPs are not subject to Title I, the FDIC has no authority to directly require CCPs to address barriers to their resolvability. The second point on the slide here is that the regular backup FDIC supervision for GSIBs is a critical component of our resolution readiness. The FDIC maintains an on-site presence at all of the U.S. GSIBs and has visibility and insight into these firms that really helps in the preparation and implementation of our Title II resolution plans. Because we are not a backup supervisor for the CCPs, we don't have the same visibility and insight. It is far more limited.
Could I ask a
Go ahead.
dumb question?
Sure.
How many such entities are you responsible for? In other words, how many CCPs have you defined in this category? And do you have an idea for if one CCPC got in trouble, how much money are we talking about? Are they big liabilities that might be there?
So I'll answer the first question. We actively plan for, do firm-specific planning for 5 U.S. CCPs. Those are the 5 of the 8 FMUs that have been designated by FSOC as systemically important that happen to be CCPs.
Okay.
And the I should have that number in front of me. It's a sizable number if one of them was to fail, but I can't recall off the top of my head exactly what the magnitude of that would be. But we'll have to come.
Billions?
Yes.
Okay.
So for the backup supervisory authority I just mentioned, we just don't have those for CCPs. And we rely on our relationships with the CFTC and the SEC and information sharing arrangements with them to learn key information about U.S. CCPs and their operations. Next, as a result of reforms following the global financial crisis, the organizational structure of GSIBs has been greatly simplified and improved, including by requiring a clean holding company that further supports the SPOE strategy. By contrast, CCPs are often deeply integrated with affiliated exchanges and service providers or are subsidiaries of much larger groups. Those relationships complicate both their point of entry considerations and separability. And for GSIBs, there are well-defined capital and liquidity triggers. I think we discussed those, quite a bit with Ryan this morning, that seek to provide assurance that even as the firm enters resolution, loss-absorbing capacity remains. These triggers are critical in helping the FDIC identify when and how we should start heightening our readiness or making recommendations for entry into resolution. And they also give a clear indication of how much loss-absorbing and liquidity resources would be available for resolution execution. The CCPs don't currently identify such triggers, and as we've previously said, U.S. CCPs have not been required to raise additional capital or reserve any resources that would specifically support an orderly resolution. We also can't rely on sufficient CCP recovery resources in resolution, and any end-of-waterfall resources that may remain to us when we enter may be destabilizing in their application. These surrounding circumstances, plus the challenge that a failure of a CCP could materialize rapidly, further underscore the importance of planning a BAU and the need to dedicate resources for CCP resolution. And we'll do more on the resources point in a bit when we discuss the FSB's new resolution resources standard. So I think maybe we could wait to have any discussion of that until after the next presentation. But for now, I think we could stop and open up the floor for discussion. We've got a couple discussion questions here on the slide that might be instructive for us. Are there any challenges I think that folks have identified that we didn't discuss that we should be considering for a CCP resolution? And secondly,
Might help if you gave us a scenario for failure. Well, so you.
Sure.
This clearing, it's not instantaneous, it's not real time, is it? Depends on it depends on the.
Yeah, it
depends. So the problem would be if one of the counterparties failed, and then somehow the CCP would be stuck with the liability from that.
Correct.
But there is effectively capital because the.
Yeah. So the scenario would have to be one or multiple counterparties defaults to the CCP, and that effectively burns through the mutualized resources available. And the mutualized resources are both pre-funded and contingent liabilities to the CCP. So the CCP generally has the ability to call for, assessments on members, or to, in some cases, to not pay out on variation margin gains. And so the default losses would have to be large enough to either burn through that or to go so far as to affect our assessment of impact on financial stability and therefore, make a recommendation for entry. Go ahead, Penn.
Yeah, I'm just going to say, just to be clear, Aaron talked about the 2 different types of potential problems. Default losses relate to the failure by the counterparties, by the clearing members. And non-default losses are operational losses that have different ways of different waterfalls. And when we talk about capital, there are capital requirements for CCPs like there are for banks, but the requirements are very, very different. I think in some cases, the CCP is required to hold capital to ensure that it could cover a year of operational expenses. So it's nothing like the bank regulatory capital requirements that you're familiar with.
So maybe, sorry, I feel a little bit like a chicken in a fox den right now, and I'm thinking maybe I should sit on that side of the table, not this side of the table. So let me try to take a shot at it. By the way, I think the presentation was really good. I think you covered a lot of the issues that CCPs and I guess ultimately a CSD would have. But I think the important point is about the different business model, right? And it is a very different business model. And I would, before I say anything else, I would not underestimate the point you made earlier about working with the SEC as an enforcement regulator versus the Fed or somebody. I mean, that's going to be a very different dynamic.
That's exactly right.
Hopefully one we'll never have to face. But couple of things on the business model. And I can't speak for all CCPs. You know, I can speak for DTC and a cash CCP. Can't speak for the Options Clearing Corp, for example. But a couple of things. One of the, we do have capital, but as Penn said, we look at capital differently. It's not really to absorb a loss. It's to keep the ongoing running of the business for a certain amount of time. We have a right, in our case, not all CCPs have that, but we're the biggest, right? We have a right to call capital from our member firms. And in our case, we can do that whether it's a default or a non-default. So if we get hit with an operational issue, we have that same right to call capital. We certainly don't want to do that. The other difference in the business model that we might see from a GSIB, there are a number of things. One is there is a large amount of concentration, and I do think that's coming through the CCPs. And I think this conversation is very timely. So let's just talk about the two major market structure changes that have happened in the past year are happening. T+1. We've cut the settlement pipeline risk in half, which is a good thing. But we've shortened the amount of time it takes now to instruct and then settle the trades. In a T+2 environment, sorry, this will all make sense at the end, but in a T+2 environment, our members had from 4 p.m. close of the exchange to 11:30 a.m. to send in files to meet the net at NSCC. That is now down to 5 hours. To meet the net in a T1 environment, you've got to be into us by 9 p.m. on trade date. So there is an issue in terms of timeliness on that, but you net, and to be quite candid, we actually reduced, because of the shortened settlement cycle, we reduced our clearing fund from what was on average $13 billion a day to $9 billion because we reduced the settlement pipeline risk. So we've returned $4 billion of liquidity to the industry, which is a good thing. But my point is the window's narrowed. The second thing that's happening is Treasury clearing. With the mandate of moving more treasuries into central clearing, there's a greater concentration. So for example, for us, a year ago, we cleared $5 trillion a day through FIC. On September 30th of this year, we cleared 10 trillion, and it will grow, although there will still be a lot of bilateral trading in the system. People don't realize that. The concentration will grow. That's a critical point and drives home the point that you made. So that's why it's important that we talk about it, because as we were saying earlier, there is no Friday in a CCP. It's immediate. And there is no time for a wind down. Trades have to settle on T+1. Treasuries have to clear. If it doesn't happen in a CCP, it's not going to be good. So the idea of a resolution has to be much more immediate. There's no time. There's absolutely no time to wait. We can't. The markets are going to keep going. The good news is the business model itself is very simple. It's a simple model. It's not like you're dealing with a complex GSIB. You can get your arms around it pretty quickly. You can operationalize it pretty quickly. You know, I think that's important. The second thing is even in the event of a double deal with default, we have the collateral. The CCP has the collateral. It's not gone anywhere. It's about access to liquidity. So in a default event, in my opinion, and when we've modeled it out, it's about access to adequate liquidity to settle the other side of the trade to keep the markets functioning. And that's what the members want. So
Okay.
those are the considerations that make it very different than we're talking about a GSIB recovery and wind down.
Yeah, and I think to just put a fine point on that, like we focused in this on our discussion between the differences between GSIBs and CCPs, but it's worth noting that there are significant differences in the business models of the CCPs themselves in the United States here. What Frank is describing with DTCC for FIC and NSCC in particular is that they are cash clearance models, whereas the other three that we do are from specific planning for the Options Clearing Corporation and CME and ICE Clear Credit are all derivatives focused CCPs. And so the exposure, the duration of exposures that they're clearing and the like, they're different. The way that they set up their waterfalls for managing default losses is different. The idea of exchanging margin daily is slightly different as well. So we are seeking to take those differences between those specific CCPs business models into our firm's specific planning account as well. That hadn't been the primary focus of the discussion here, but I just want to make sure that that's clear.
I just think it's important, everybody.
Yeah.
It's not a one size fits
It
all
is not.
model.
It is not.
It's just not.
No,
right?
it is not. And you mentioned the dealer default issue. That is I think probably a default loss that leads to a CCP resolution is a very it's a low probability event, but a very, very high impact event if it were to happen, if the CCP was to go into resolution. So that's, I think, another reason why we're here talking about this is it's an important issue to consider, even though it's far down the tail of the risks that we face. It is the impact is so great that we think it's critical to talk about. Go ahead.
Aaron, of the 5 of the 8 CCPs that you have strategies for, how many of them are overseen by the SEC and how many by the CFTC?
Sure.
And does that make a big difference?
Yes, it does. But I'll clarify one thing really quickly there. It's that FSOC has designated 8 financial market utilities, 5 of which are CCPs. And I apologize if I wasn't clear with that there. So the other 3 are CHIPS and CLS, ostensibly payment systems, and DTC, which is a central securities depository. So it sits within the DTCC umbrella, but it's not a traditional CCP. So I mentioned it's NSCC, FIC, OCC. Not the OCC we've been talking about all morning, but the Options Clearing Corp and ICE Clear Credit and CME. The second question you asked, I apologize.
How do they divide?
Oh yeah, SEC. So the SEC is the primary regulator for the DTCC ones, so NSCC and FIC and the Options Clearing Corporation. Options Clearing Corporation is duly registered as a derivatives clearing organization with the CFTC as well. The CME and ICE Clear Credit are primarily overseen by the CFTC.
Yeah, the cash side of the market is regulated by the SEC. The derivative side, the futures side, is the CFTC.
Good.
And it does make, it does make a difference just in terms of, different agencies' approaches and authorities to supervision and regulation. We seek to build, good relationships with both, and we are in contact with them on a very frequent basis to discuss issues about CCP resolution and to learn, more about how they supervise and think about, resilience and recovery for CCPs. So, in terms of building relationship, I don't think there's much difference there, but their approach to the supervision of their CCPs is different, and I don't think I have the wherewithal to get into the details of that here.
The other question that occurred to me, and I'm not sure of the answer, is one that popped up this morning about what if a number get into trouble at the same time. It strikes me, without knowing an awful lot about it, that the prospect of contagion may be bigger with regard to CCPs because you don't have a non-bank sector, a non-financial institution sector to lay losses off on. It's all going to redound within the financial system. But do you have a handle on how realistic it is to expect one at a time?
We tend to think that if one of them were facing stress as a result of a kind of a especially in a default loss situation, that is less likely to be an idiosyncratic scenario. The largest clearing members of the CCPs tend to be large clearing members at all of the CCPs. And so, a default at one necessarily means a default at many. That does impact our thinking. It's very hard to model. It's very hard to actually, go down the route of quantifying how that would manifest. But we are actively thinking about that and trying to account for it in our plan.
Do we have any stress tests to give us an idea?
Both the CFTC and SEC do supervisory stress tests.
But they do them simultaneously on.
They right now I don't believe they do that. The CCPs themselves also do daily stress tests in many cases. They're constantly stressing their own portfolios.
No, it's the systemic piece.
It is the systemic piece that is difficult. I'll make a nod to the Europeans. ESMA actually has modeled out network stress tests for CCPs, which are quite good. They're interesting, and they do seek to take those network effects into account. The Bank of England is also embarking upon its system-wide exploratory scenario, which is beyond just CCPs, but again, an attempt to model out kind of a financial stability impact.
No, I was kind of make one point on challenges, but just on, I think you hit the nail on the head with this is about how far into the tail of the risk distribution you want to go. So, protect it, and the idea of bankruptcy doesn't really exist for CCPs because their rule books allow themselves to wind themselves up and tear up all the contracts. It's really so the rule book says the CCP not bankrupt, it just ceases operation, but it leaves everybody else without protection. And from a financial stability point of view, that's not an acceptable outcome. But you're not trying to avoid a bankruptcy and an insolvency. And the losses are very difficult to size because, and I'm talking, I used to supervise the London Clearing House, which has a lot of very long-term derivatives, 20 years, interest rate derivatives in there. So if the market is moving fast and you get a big default of 2 or 3 clearing members and the CCP suddenly has got an unmatched book, the size of that loss can just balloon out, and you can't size it by saying it's 2 times capital requirements or whatever. It's a judgment call now about how much risk do you want to protect against. And people say, well, let's have a complete reload of the default fund, because that feels like a reload of bank capital. But in my view, it's not very relevant in this particular situation. It's much more a question of who manages this situation now and who uses the resources, and do you let CCP management sort of control this or not? And can you depend on a cash call or further calls on the other members? Because in a time of crisis with 2 or 3 big banks gone down, you're putting additional strain, or do you want pre-position resources? And if so, how far they are. So it's very difficult to find answers to size this thing. And as I say, in Europe, we've decided against a second round of pre-position resources, because first of all, you've got the initial margin of the defaulter, then you've got the default fund, then we turn to cash calls and variation margin gains haircutting, but you could do pre-positioned resources. It depends a lot about the coordination between the CCP supervisor and the resolution authority, and understand the differences here. The one thing I don't think you've taken, or you might think about, is that many of the largest CCP clients also hold the liquidity and provide services to the CCP. So if 1 or 2 of the big investment banks were to go down, then it's not just that they can't meet the margin, but the CCP may well have parked its liquidity resources there. I think some of them can park at the central bank, but you've got a much more complicated relationship between the big investment banks, who are the main threats, and the CCP than just the default. And I think we've not quite sort of pulled apart how you would manage that if you're managing the default of somebody who is also holding a large bunch of your liquidity.
But no, and John, you're right. I just think, just for the avoidance of doubt, we shouldn't conflate a double deal of default with a default at the CCP. They're totally right, but I just want to be clear about that. You know, the CCP will manage that default, right? That's what they're intended to do. But John raises an interesting point around governance. So some CCPs are user-owned, user-governed, which means the participants are on the board. So you've got to think about, in the event of a CCP default, what the governance goes. So we talked about it earlier this morning, right? You know, what do you do with your board? But you've got to consider the governance pretty quickly, because you potentially could have some very conflicted board members because it is user-owned, user-governed, right? Right. So that's a consideration that you got to put into the mix. You know, and as John said, I mean, look, nobody wants to tear up trades. Like, that's the last thing anybody wants to do. It really is it's put in a last resort. Right.
So let me offer an observation and then a question which may be fatuous. So the observation is, listening to this and hearing about a lesser degree of progress, it seems to me this may reflect more than anything the absence of sufficient tools. And so the fatuous question is this something which Congress should be dealing with, other than the merger of the SEC and CFTC, which I don't think will be happening?
I'm not going to touch either one of them.
I think, Rajan, if I may, since I was around back then in 2008, and when the Dodd-Frank Act went through, as you well know, as well as me, Dodd-Frank dealt with the supervision of CCPs, but it did not deal with the resolution of CCPs, and which is in striking contrast to the GSIBs, in which there was both a set of supervisory authorities provided and a substantial framework for GSIB resolution, which was a source of conscious attention and substantial authorities provided. And the fact is that they concluded the title dealing with CCP supervision at the last minute, and they had no time to think about resolution. And so we were left with some sense, an incomplete framework from our standpoint as a resolution authority, in which Title II was established with authority for the FDIC to manage the orderly failure of any financial company, whether a bank or a non-bank financial company that may pose financial stability risk. But we were only given tools to deal with the bank situation. We were not given tools to deal with the non-bank scenario, including CCPs. And we have not yet, and I don't think, to answer your question, yes, there would certainly be a logic for Congress to come back and fill that statutory gap in authority, but I don't think the prospect of that is high anytime soon. So I think, as a practical matter, we have to work with the institutional framework that we have, in which the FDIC by default would be the resolution authority, because CCPs almost certainly would be of systemic consequence if they were to fail. But the market regulators, the SEC and the CFTC, have both the supervisory authorities, and to the extent resolution planning exists, it falls under the rubric of their recovery and wind down plans. And what you'd need is some cooperative effort between the FDIC, the market regulators, the Federal Reserve, no doubt, would have to be a participant in this as well to try to cobble together and adapt a framework to try to establish some capability here, which we have not arrived at yet. We've had a good deal of discussion, made a little bit of progress with the market regulators to the extent they expanded their rule relating to recovery and wind down plans to provide more information relating to the wind down scenario, which is their terminology effectively for resolution. So that was a step in the right direction, but we, for better or worse, have a long way to go. And I don't know yet that we have the institutional cooperation in place. I don't know how far we can get in that direction, but I think that's a fair, and I'll ask staff to check me on that if I'm wrong, but I think that's a fair characterization of where we are. And in the international context, I do think some of the other leading jurisdictions, the UK is a notable example of this, have established a more complete institutional framework. I think the European community is moving in that direction as well. I think that remains a challenge for the US. And since we have a number of the large CCPs, it's a significant issue.
I think that's a good segue to the next portion of the presentation. Turn it over to Jenny.
Sure. Thank you. So for this next and final session of the CCP presentation, we wanted to focus on an international standard, which was put in place by the Financial Stability Board earlier this year. And maybe just to put it in some local terms, so within the Financial Stability Board, this was work done by the Resolution Steering Committee, or RESG, which our chairman is the chair of. And then there is, sitting under RESG is a subgroup that focuses on financial market utilities. That's co-chaired by Art Martin, and I'm the FDIC's member in that group. And I was going to make the point that this group that focuses on FMUs has been around for a long time too, but similarly it lacks in progress as compared to GSIB, the parallel group that works on GSIB resolution. And we've talked a lot already about why the US resolution planning is difficult and challenging. I think it's now pretty apparent. But in this group too, when it started back in 2015, at that time, a lot of jurisdictions hadn't even established the resolution authorities. And so as a result, in this group that, is represented by jurisdictions around the world, you had a real mix of a lot of supervisors. You had agencies that might expect to be made resolution authority, but weren't yet. And then some jurisdictions with resolution authorities. And that sort of a more like heterogeneous group of perspectives meant that the focus of that group, or maybe the way that authorities look to potentially solve problems, had more of a supervisory focus instead of being like really core resolution focus. And so like an example of that might be, let's focus on making sure that recovery works so we will never get to resolution, instead of what happens if we do get to resolution. And so it's taken some time to work through some of those different perspectives. And I think another reason where we've sort of, it's taken us a little bit longer to get to where we are on the resources piece is that when we started, there were also not resolution regimes specifically in place for CCPs. In 2015, I think the US was looked at as being like far out and ahead because we had a regime that applied to CCPs. It's Title II of the Dodd-Frank Act applying to financial companies. And I think that was probably one of the reasons that we were asked to lead that inaugural group and have been in there ever since. But in the interim, we've seen other jurisdictions like the EU or the UK come out with regimes that are explicitly focused on CCPs and take into account those considerations and how they're different from GSIB resolution. So the standard is an important step forward. It's focused on resources, and by that we mean financial resources to support resolution. And it's specifically geared towards an expectation that resolution authorities should have access to certain types of resources reserved to support resolution. And that is above and beyond what may be left over after recovery has taken place. So this is dedicating financial resources to be there to support an orderly CCP resolution. So with that, I'll let Erin walk through sort of more context and how it's meant to work.
Thanks, Jenny. Appreciate the background there. As she mentioned just now, this new standard came out in April of this year, and it is meant to ensure that resolution authorities have access to financial resources and tools dedicated for resolution that could be used without an adverse impact to financial stability. Again, I think it goes without saying, but I'll say it. The FDIC did strongly support this initiative. As we've alluded to several times, we came at this from the point where while CCPs have substantial recovery resources and tools, we don't think resolution authorities can guarantee those resources will remain to them in resolution, or that if they do remain, if the resolution authority steps in at a point where they do remain, they may not be, they may be themselves destabilizing in their application. And so this is why the authorities at the FSB believed it was critical to adopt this standard to ensure that those resolution authorities for systemic CCPs would have access to those resource options and could support an orderly resolution and financial stability objectives. As laid out on the slide here, the standard expects that resolution authorities have access to what we call a set of resolution-specific resources and tools, and then to be transparent about the approach to calibrating at least one of those resources or tools. This is something that we've described as a quote-unquote toolbox approach. So the FSB identified and analyzed seven different resolution-specific financial tools or resources in the standard. We should be clear, each one of them has their own specific strengths and weaknesses. So the authorities determined that a combination will be necessary to achieve the objectives of a resolution. And before we get into a discussion of what's in the toolbox or the available tools, I'll just note a point of confusion that's come up in the past, that jurisdictions can select their preferred resources and tools that would be appropriate to their jurisdiction from this set, but that they're not required to adopt all of those on the list. So you don't have to come at it and it doesn't expect you to come at it and adopt all 7 for your regime. But I guess we'll just spend a few moments going through the list of resources and tools here and some of the benefits and drawbacks for them. Bail and bonds, I think, are fairly well known. They're subordinated debt or unsecured debt, ranking junior to other liabilities issued by a CCP to recapitalize the CCP and absorb losses in resolution. Something like TLAC, but adapted to CCPs. And a CCP would issue the bail-in debt in BAU periods for use in a potential resolution scenario. They would, for example, allow a resolution authority to convert those liabilities into equity in the CCP. And they have the benefit of being pre-funded and thus may be available with more certainty in resolution. But as you can imagine, they may also increase the cost of clearing. Resolution funds are dedicated pre-funded resources which can be called upon in resolution by a participating resolution authority. A resolution fund could either be national or supranational. Covered CCPs or clearing participants would be expected to contribute to the fund in BAU, and their operation could be similar to that of a deposit insurance fund or a bank resolution fund. They come with some of the similar drawbacks and benefits as bail-in bonds, but would also be likely considerably challenging to establish operationally. Resolution-specific insurance is a contract in which an insurer agrees to provide funding to the resolution authority or the CCP. The terms of the insurance would vary based on the policy and could be structured to address specified risks in resolution. Resolution-specific third-party contractual support would represent contingent resources provided by a third party available to the resolution authority or the CCP in resolution. These financial resources would be specified in the contractual documentation and could be structured to address specified risks in resolution. Insurance and third-party contractual support are quite similar in their features and drawbacks. Both could be structured to satisfy most resolution needs, but depending on their design, they may be lacking in timeliness, so your ability to draw upon them, and may come with some legal and operational uncertainty.
Can
can you use you and the SEC, et cetera, use your power over the participants? Or say, if you're going to participate, if you're a big participant and you're going to be in the CCP, you have to buy contingent bonds. It seems like an indirect way to get at the problem.
I don't believe that's the case. I mean, people will only buy bonds that are issued, and we certainly can't require that the CCPs issue bonds.
But the participants own the CCPs.
That's not necessarily the case. That is the case in certain cases, but I believe CME is a publicly traded corporation. I think ICE is the same.
Yeah, ICE Clear Credit is a subsidiary of ICE Intercontinental Exchange, a for-profit corporation. So
this is such an important question, though, and I have no idea what percentage of the volume, and I know it will vary from CCP to CCP, is conducted by entities which are not comprehensively regulated. And yeah, like a Federal Reserve, FDIC, OCC regulation. I mean, trying to figure out what the weak points really are here. If default is probably the greatest issue, and you have entities which are not well regulated.
So I think it's worth pointing out that the largest clearing members, the clearing members with the largest exposures to the CCPs are generally GSIBs.
Yeah.
That's not always the case, so I don't want to make an overgeneralization there. But there is another issue worth pointing out is that large clients can often clear through multiple members, right? So their access model is dependent upon clearing through a member who guarantees their trades to the CCP. And those clients can often build up quite large exposures that we don't necessarily have direct visibility into because we don't always know who the biggest clients are, and we don't always know who they're clearing through. And we at the FDIC, will not speak for my supervisory colleagues, but we at the FDIC don't always have a comprehensive picture of what that total exposure would look like from a large client, so not a direct clearing member.
But I think it's safe to assume the vast majority of participants to CCPs are regulated either by the SEC, FINRA, or the CFTC. It's not non-regulated entities that are members of the CCPs.
Yeah. Gary, I see you have your hand up.
I do. In relation to Raj's question, the largest clients today, probably in many respects outside of the GSIBs, are the, I would say, lightly regulated electronic market makers. So you could go to the Citadels, the Two Sigmas, the Virtues. Those, and if I were telling people where I would worry, and if I've looked at all the historical problems, I would worry on electronic trading, fat finger in a derivatives market. I don't think we have to worry about the cash market. Cash market's really hard to create a systemic problem. Really easy to create a systemic problem in a derivative market where all of a sudden, if the derivative market moves, people's exposure compounds and really multiplies dramatically and dramatically quickly. And those markets, the biggest market makers, I would say, are probably the lightest regulated we have. And it's just an effect of the regulatory environment we created in 2008.
It's a really helpful point, Gary. Thank you. So if there are no further questions at this moment, I guess I'll go on and finish describing the resources and tools. So resolution cash calls, which I think have been mentioned here already, and we'll discuss a little bit more in just a moment as well, are there contractual or statutory provisions that enable the resolution authority to make one or more capped cash calls on the clearing participants once the CCP is in resolution. These are separate, and in addition to any cash calls the CCP may itself have in its rulebook. Recovery cash calls are well understood because they are in most CCP's rulebooks, not all of them, but most. And so they're well understood, and then depending on design, they may be predictable in their use. However, in a systemic crisis scenario, their use may have financial stability impacts. Similarly, statutory or contractual variation margin gains haircutting, or VMGH as it's known, for resolution as a means for specifying that the resolution authority has an independent right to delay, reduce, or cancel variation margin payments in resolution. Again, this is separate and in addition to any VMGH that might be included in a CCP's rulebook. Similar to cash calls, VMGH is well understood by CCP members. It is, however, inherently less predictable than a cash call because in advance, because it would depend on who is owed margin on what day and what is happening in the markets. VMGH might also have financial stability impacts in its use. And then the last tool, equity write-down, refers to the resolution authority's power to use existing CCP owners' equity in the CCP to absorb losses in a first loss position. Equity write-down could be useful in resolution, but may not be available in sufficient amounts. We've highlighted here, again, there's been discussion of this, we've highlighted on the slide 2 jurisdictions that have made meaningful progress. The United Kingdom, under the leadership of Sir John Conliffe here, when he was at the Bank of England, and the EU, who were both ahead of the FSB. It's worth noting that too, in adapting adopting a set of resources and tools available to their specific resolution authorities. I think, as we may have already mentioned, both have already established resolution regimes that reserve cash calls and VMGH for the resolution authority, in addition to those that are available to the CCP in its recovery efforts. They also both have the powers to remove impediments to resolvability. So that's, I think, an important point to make as well, just given the nature of our last discussion, where that's not an authority available to the FDIC. The United States, by contrast, doesn't have any of these resources or tools, these financial resources or tools, sufficiently available to draw upon in the event of a failing U.S. CCP. The FDIC would be able to write down CCP equity in resolution, but the amount available is unlikely to be, or is likely to be relatively small, and alone may not meet all resolution objectives laid out in the standard. Go ahead. Yeah, next slide.
Can I ask a question?
Go ahead.
Before we leave that slide about something that's not on there?
Sure.
People talked about the procyclicality of initial margin. It's not technically a resolution tool, right? Initial margin saying hopefully it avoids resolution, but it still seems to be part of that continuum of how far away you are from the tail. Do we have any tools to maintain sufficient amounts of initial margin, even in kind of, sanguine markets, make sure that they don't dip low and then have to be hiked really high when this crisis hits?
So that's not work that the FDIC has been a part of, just because of the nature of our lack of supervisory authorities. But there has been a very substantial international effort in the domestic level to analyze initial margin and to ensure that anti-procyclicality measures are in place at the CCPs to effectively guard against that issue, so that they're sufficiently high in peacetime and aren't ramping up excessively in times of crisis. But I can't speak to the details of that because that's not work that we're involved in.
Does the Fed's margin authority extend to this?
That's a good question. They have in Title 8 of Dodd-Frank, they were identified as a backup supervisor for systemically important FMUs or CCPs. I can't say for sure whether or not their authority extends to requiring margin levels. But it would be a backup authority, and I'm not sure that they have used that backup authority in that way. Okay. So I think we can move on here. So again, to come back to the United States just for a moment, where I said I think we in the United States would need to adopt additional financial resources and tools to be more confident in our ability to meet financial resource needs in resolution. However, adoption of any such resolution-specific resources would likely require regulatory or legislative action and is not under the control of the FDIC. I think it is important, though, that we kind of do talk about what is available to us. And, at the risk of beating a dead horse here, I've mentioned a few times that we don't rely on CCP recovery resources in our own resolution planning because we don't expect that those recovery resources will be meaningfully available to us at the point of resolution. But as we've talked about a little bit this morning, and as you're likely already familiar with in GSIB resolution, we do have access to the same dedicated liquidity resource that could be potentially drawn upon in the event of a CCP resolution scenario, which is the orderly liquidation fund. Ryan talked about this in actually pretty decent detail this morning for GSIBs, but I'll just mention here some of the challenges associated with borrowing from the fund for a CCP. It comes with statutory restrictions that leave its utility in a CCP scenario uncertain. For example, the design of the fund itself, and this gets to something that Marty was talking about in Dodd-Frank, not really contemplating a CCP resolution. It appears to have had financial companies with very large balance sheets in mind, such as those of GSIBs. Because borrowing from the fund is predicated on balance sheet size. So Brian mentioned that we would be able to borrow significant amounts for a GSIB resolution from the orderly liquidation fund. CCPs, though, for those of you unfamiliar, actually have very thin balance sheets with very few assets, financial assets sets of their own on them. And so borrowing from the fund for a CCP is likely to be limited. The OLF is also meant to be a last resort after all other options have been exhausted, and it should not be the primary resolution resource. So, with that, I think I can turn it over to the committee for our next discussion pause here, which is to focus more on resources and tools as we've been discussing. So next slide, please. So we've got a couple of questions on the slide here that may prompt some discussion. Supporting orderly resolution requires resources and tools with certain characteristics such as purpose and usability, timeliness, impact of financial stability, et cetera. How should these characteristics be compared with the cost and incentive to clear implications associated with resource adoption? So we talked about how some of the benefits of certain of the tools are their availability for use and what you can do with them, but they may come with cost implications. And then of the characteristics we've identified here, are there any that we should be prioritizing as we assess what we may want to pursue? And lastly, what could the FDIC do? What more could the FDIC do to ensure access to resources reserved for CCP resolution? Maybe there's nothing.
Yeah. I'll break the ice. Just I do this idea of really breaking down scenarios is important. So what do I mean by that? To me, from my perch, I'm more worried about a non-default event than I am a default event. I think CCPs have a lot of resources and experience in terms of a wind down, even if it's a double deal with a default. I'm not trivializing it, don't get me wrong. But think about a cyber attack, think about a major operational outage where the CCP goes down, right? Now that to me, my word to the wise, I would really think I would prioritize the scenarios out in a certain order because you can't boil the ocean anyway. And I would think about, as I said, non-default scenarios before I would think about default scenarios. And then when you get to the default scenarios, it's really around, liquidity and access to liquidity.
Right.
That's how I would, I'm oversimplifying it, just not to, it's been a long day, but that's how I would sort of think about it. I hope that makes sense. I hope that makes sense with what you've seen.
That's really helpful. Thank you. I think one of the things that I mentioned this early on is, thinking about the different scenarios. One scenario that could precipitate from a non-default event would be kind of a system-wide attack or something that affects actually multiple clearing members and actually causes a default event, and that's another thing. So we are actively working on scenario identification and trying to, figure out what may put a CCP into resolution and think about how we would, address those. Thank you.
So first of all, I agree on non-default, and you have an argument with the members understand that they're mutually insuring each other, ensuring the CCP management against operational failure, and saying that basically the members of the CCP should pay for the CCP's management's failure to conduct the operations properly is quite difficult. But I think you have to give access to a cash call or to the default fund for non-default as well. But then basically you're making it can be presented that you're making the members pay for the management's incompetence, if I can put it that way, and that's quite hard. The point I made just, and I understand why you've gone to resources and you've kind of listed what the Europeans and the UK have done. But it's, we did try and approach this thing in the round. And remember, if you're in a default loss position, the CCP auctions and it auctions the positions of the defaulting members, so that other members of the CCP will buy those positions, and the CCP will then get back to a match book, and the default fund is there to cover the loss that it takes when it auctions those positions. The point at which the resolution authority comes in and says, we are now running this operation, and we are running the auctions. And if you look at some of the near default instances we've had, there's been huge conflicted objectives between CCP management, particularly where it's proprietary, it's a private company. That's where some of the frictions come. So the ability to get in early while there are still some resources left and to run those auctions. And if you are going to do sort of variation margin gains haircutting, to decide where the kind of costs, who the cost should fall upon in a systemic crisis is kind of really quite important. And you can't divorce that from the financial resources. One tries to kind of look at the thing in the round, and you can't divorce it from being able to tackle the barriers to resolution ex ante, and to have clear line of sight to the CCP's operations and what you might need to do, because you'll need to come in very, very quickly. I mean, the exercises we did inside the Bank of England suggested we would come in as a resolution authority probably after one default, after one failed auction of defaulters' positions. We wouldn't let the CCP management run again. If you don't have any of those things, and it kind of looks as if you don't, then the only thing you've got is pre-positioned TLAC or pre-positioned resources, and I can understand why you've gone there. But if you're thinking about because you'll need legislation or something to get bail-in bonds or some form of pre-positioned, I think my advice would be to think, well, if you're going the legislative route anyway, and there's support for this, maybe think in the round about how you manage a default, rather than just concentrate on can we get the financial resources, because it's the dealing with this in the sort of fast burn situation. You need far more levers than just bail-in bonds. Sorry, it's a nightmare.
That's really helpful. Thank you.
So
I got out in time.
Well, we thought we would put this issue on the agenda for discussion. To be continued, but the challenges here, I'm afraid, are self-evident. And I think we've come to the end of our time today. So before I conclude, let me just say how helpful this meeting has been. I think we've all been taking notes, and the feedback has really been of enormous value. We'll see if there's anything here for us to follow up with you on. And before I adjourn the meeting, let me just note, as I was going home at the end of the day on Friday, I came across a group of our staff who were working to set up this meeting and all of the logistics that go into it. So let me, if I may, just take the opportunity to acknowledge them, because we wouldn't have had this nice meeting today without them. So let me mention Christy Hughes, Narati Shah, Sharice Muhammad, Rosalind King, Mitch Miller, Akbar Tajuddin, Brian Smith, Veri Bompo, Laura Crawford, and Jerome Brown. Thank you all very much. And thank you all very much. Thank you.
Is for the financial.
Always interesting to get.
Is for the financial.